Hello, everyone. So it's 9 a.m. straight, and we'll just start. Welcome to the Summer Investment Summit for high school students. We are going to have 8 fantastic guest speakers today, covering 14 topics across these next 2 days, 2 half days actually. All speakers will speak first, and we'll follow with a short Q&A. And we'll have a 10-minute break before the next speaker joins us. Please stay online and enjoy some free time. You can find more information on our website at summerinvestmentsummit.org.
We want this to be as interactive as possible, so please be sure to ask questions in the chat or during the Q&A session. We will introduce each speaker, and then they will get into what they're talking about. And without further ado, this is our first speaker, Mr. Sanford Lays, and he is a professor at UT and has worked as a prosecutor and money manager. He has been a member of the faculty at UT for 21 years and puts out a free weekly newsletter that you can find at sandyleeds.com. We'll post that in the chat. And thank you so much, Mr. Leeds, for being here.
Great. Well, thank you so much. Thank you for inviting me to be here. Let me put up my slide deck so we've got it up here. So welcome to everyone who's here. Again, I appreciate being invited to speak to you. I think it's an awesome idea to get people thinking about the markets and investing and finance at a relatively early age. Some of you have probably already been thinking about it for quite some time, and others might be just dipping their toe in and trying to think about if this is something that's interesting to you and that you want to study in college. And I hope it is. I'm going to start with just one simple poll, and we'll just to sort of get people thinking. Don't feel funny about getting things wrong. We're not looking at who's answering and what your answer is, but we'll just look and see what you think. So over the next 20 years, what do you think the S&P 500 will average as far as returns? And then there's a second question that asks if the Fed thinks that inflation is going to be a persistent problem, what are they going to do? Do they raise rates or lower rates? Give you just about 30 seconds to do that, and then we'll close it out. All right, last call in case you want to answer it. And close it out here. Looks like some more answers coming in. All right, so let's take a look at the results. It looks like the majority of you said 4 to 9%. That's actually fascinating to me that you said that. I would agree with that answer, and I think if you asked the general public that question, and people who have been following the stock market for longer than you have, most likely on average, they would have a higher number than that. And I would say, excuse me, I think that 4 to 9% is probably right. And then you also got the other question, right, about the Fed thinks that, and not to say the first one you got right, we don't know who's right or who's wrong, but it shares my opinion. And the second one is, if the Fed thinks that inflation will be a persistent problem, what they do is they raise the Fed funds rate, as 80% of you said, in order to slow the economy. So I asked you about the returns because that's a super important idea, to have reasonable expectations. What I'm going to do today is I'm going to take you through my presentation is sort of divided into two parts. One is background knowledge that you should have, and then the other part is some key events that are that we're thinking about in the markets right now. And so I'm gonna Tiana, if you don't mind, there's an outline. If you could post the outline for everyone. It's just a one-page outline that will help you to follow along, and it will just it just always makes it easier if you sort of know where we're going. And so what you can see if you're looking at the outline is that we have two sections, sort of key knowledge, where we're going to talk about stock returns and understanding interest rates. And then we're going to talk about some key current events. So I don't know that we'll get through all of it, but I'll try to leave a few minutes to ask questions. So this is going to be probably the single most academic slide I'll show you. And I should tell you, as was mentioned, I'm I was a money manager. I ran the MBA investment fund for about 13 years, where we train students, MBA students, to become money managers. Now, what I mostly do at UT is I teach all about the markets and the economy, so that students who are going out and into these fields understand what's going on. The way I always describe the purpose of my class is for students to not feel like a fraud when they graduate. With academic knowledge, super important, but also understanding the real world. But here's how to think about what kind of returns you're going to earn over time. And that is, you have earnings growth, you have the change in the multiple, and the dividend yield. And we'll talk about what that means. So let's imagine you have a company that is selling. Let's just say they have earnings of $2 per share, and then they're selling for $10. I'm sorry, they're selling for 10 times earnings, or $20. So that 10 times earnings is called the PE multiple, the price earnings multiple. And so if you're selling at 10 times earnings and earnings are $2, that's a $20 stock. Well, let's imagine that it continues to sell at 10 times earnings, but the earnings grow 6% per year. Well, then your return is going to be 6% per year, plus any dividend you get. On the other hand, if the earnings grow plus the multiple expands, so instead of paying 10 times earnings, people are willing to pay 15 times earnings, then you're going to make even more. Of course, earnings can shrink, and multiples can contract, can become smaller. So let me just show you a quick sort of example of this. And I say stocks are currently trading at 14 times earnings. So that's the multiple. Over the next 5 years, you expect earnings to grow 6.5% per year, the multiple to expand to 16, and an annual dividend yield of 2.5%. What will your compound annual growth rate be? Your CAGR, your compound annual growth rate. How much are you going to earn per year? So I show you two different ways of solving this. So the easiest way to do it is, I didn't tell you what the earnings were. It doesn't matter what you start with. The answer will come out the same. So if you want to start for some reason with $3.46 of earnings, that's fine. It's just a little bit harder math. I start with $1. So if the multiple is 14 right now, and that's what we said, that stock's currently trading at 14 times earnings. Well, with $1 of earnings, that means the stock is worth $14. And if earnings are going to grow 6.5% per year, that dollar is going to grow to $1.37. And then I said at the end of 5 years, my expectation is that the multiple will be 16. And so you're going to have a $21.92 stock. So if a stock goes from $14 to $21.92 over 5 years, that's a 9.38% return. So you have your ending value divided by your beginning value raised to the one end, meaning how long it took. And you get the rate of return. If you skip to the bottom, then you have to add the dividend yield, and your total return is 11.88%. That first part where I got that 9.38, we could have done it in another way. We could have said, look, the multiple is going to expand from 14 to 16 over 5 years. So that's going to give us a 2.7% return. 1 plus that rate of return plus the 1 multiplied by 1 plus the earnings growth is going to come out to 9.38. So you're getting multiple expansion and earnings growth, and it's going to combine to a 9.38% return plus the dividend yield. So the point of this is not to really do the math, but really just to say to you that as an investor, when I'm thinking about a stock, what I'm thinking about is, are the earnings going to grow? And will the market find those earnings more or less valuable? In other words, will the multiple increase or decrease? And what I tell you is, as you start to invest or as you follow the market, the more you think like that, it'll give you a simple framework, right? So when you'll start to get used to the idea of how realistic is the growth that people are expecting, and am I really going to make money if I pay a really high multiple for a stock? In other words, if something's trading at 100 times earnings, that's unlikely to stay that way. Now, it's possible that the earnings are going to grow at a really fast rate right now, and they'll grow into that expensive price, but you start to get an idea of what's reasonable, what's not, when am I overpaying, when am I going to lose money? And so that's not something people get in a day or a week. It's something you get by watching the market over time. And I think, if you start now, boy, you're going to be so much better off. I have 3 kids, and they're two of them are older in college, and one of them is about to be a senior in high school, and one of them is really into this stuff, and they're doing well because of it. So if you're following along on the outline as we talk about stock returns, now I've told you we're not going to talk about dividends. Dividends with the S&P 500 tend to be 1.5% to 2% on average most of the time, but 1.5% to 2% return. But let's talk about the other 2 factors that are going to drive your returns. You've got earnings growth and you've got multiples. And the biggest thing to realize is this, that as the economy grows, earnings grow. All right, so what I have on this chart on the left is GDP, gross domestic product. That's the value of all the goods and services we produce in this country. And as we produce more in this country, you see corporate profits increase. And on the right, as corporate profits increase, as earnings increase, stock prices increase. And so that's one reason why we follow the economy, is that as the economy grows, companies are more profitable. As companies are more profitable, they're worth more. Now, this isn't a perfect slide, because if you think about like the S&P 500, those companies, somewhere between 35 and 55% of their revenue comes from overseas. So it's not just dependent on our economy, it's also dependent on other economies. But big picture, this is really good intuition to have. As the economy grows, profits grow. As profits grow, stock prices grow. That's as a stock investor, that's why I'm following the economy, or that's one reason. And then when we talk about multiples, one of the things to realize, and we'll see some other slides in this a little bit later, is that what happens is as interest rates are lower, multiples are higher. Meaning as interest rates go from, let's imagine interest rates go from 5% to 2%. What I would expect is multiples to increase. So in other words, instead of paying 12 times earnings, maybe I'm willing to pay 17 times earnings. And you might see that, you think of that's an inverse relationship. Interest rates go lower, multiples go higher. Here, what they've done is they've inverted the S&P 500. So that's why it shows the correlation, but it's really an inverse correlation. But what I want you to think about is just simply lower interest rates mean higher multiples. Higher interest rates mean lower multiples. So we're going to talk about that more later. When one of the other things that will impact multiples is sentiment. And there are times when investors are really scared. And when they're really scared, what they do is they sell everything. And there are other times when they're really optimistic and they're just buying. And we have an indicator that's called the VIX, the volatility index, but people just refer to it as the VIX. And the VIX, you'll learn about this if you study business when you go to college, but the VIX basically measures the volatility that's priced into options. But what you need to think about right now is just simply the idea that when people are scared, the VIX increases. And what I would just point out to you is, like, let's just look in June when the VIX was going up. People are scared. The market, this is the S&P 500 at the bottom, the market's going down. And then as people are becoming less scared, the market is going up. And that's what we're seeing right now. And so when people are less scared, they're willing to pay more for $1 of earnings. That's a higher multiple. When people are more scared, they're less willing. And that's an important thing to understand, is that one of the ways you make money in the market, or one of the really important things to realize, is that you make money a lot of the time by having a different opinion than others and being right. Just being a contrarian, that just makes you annoying. But being a contrarian, being right, that's what makes you wealthy. And so, the idea is, you want to be fearful when everyone else is greedy, and you want to be greedy when everyone else is fearful. That's I think Warren Buffett, famous investor, or maybe the world's most famous investor, always says that. And so that's what you see here. One of the problems when you look at something like this, like the VIX, is I can't tell you in real time how high it's going to go. There are times it's gone up to 50, 60, 70 down during all that. So you can't just say, oh, anytime it goes above 30. I was speaking to a group earlier this week, and someone said, I heard a rule that if you sell every time the VIX goes above 30, and you buy every time, you buy every time it goes above 30, or you sell every time it goes below 20, will that work? And rules like that are sort of tough to implement. So anyway, that's the knowledge part of stock returns. Let's talk about interest rates real quick. And so interest rates, what I'm showing you here is what's called the yield curve. And some of you are familiar with this, some of you aren't. And you see this this is just a chart that's put out by one of the regional Federal Reserve banks, the Richmond Fed. And the blue line is the most recent. It's from just this past week. And the red line is from a month earlier. And they're trying to show us how yields have changed. But what this is showing you is interest rates, also called yields. And it's showing you interest rates for different time periods. And what we're talking about are on Treasury securities. Treasury securities, whether they're called Treasury bills, Treasury notes, Treasury bonds, all you need to worry about, or all practitioners worry about in the real world, is Treasury securities are securities issued by the US government. And the reason that the US government borrows money is that the US government takes in money in the form of taxes, and then they spend money. But we spend more than we take in. And so as a result, we have to borrow. And so when someone buys a bond, they're loaning money to the US government. And we consider that to be risk-free, because ultimately the government can print money. So the idea is, this is sort of the risk-free rate. It's it's cheaper for the US government to borrow money than it would be for you or me to borrow money. So what you see is, like, here are this side of this chart we call the short end of the yield curve. It's just like when the government's borrowing for shorter time frames. And here at this side, we start to talk about this as like the longer end of the yield curve. And so that interest rate is just the rate that the US government pays to borrow money from us. And what you'll find is your parents and grandparents probably own some treasury bonds. They've loaned money to the government. Mutual funds, hedge funds, endowments that are that fund a lot of the universities that you're going to go to, all invest in treasury bonds. And so it's just part of their portfolio. And so this is the yield curve. We're going to talk more about this in current events in just a moment. But then the question is, like, let's think about the short end of the yield curve. Like, we'll talk about the 2-year yield. What is that? It's not some mystical number. Like, one of the things that I spend a lot of time teaching my students at the University of Texas is that, I don't want you to think that it's some mystical number, that it just appears. Markets are determining every day, moment by moment, what interest rates should be for all these different time frames. And what I'm showing you here on this chart is the intuition you should have about short-term interest rates. One of the questions I asked you in the polling was, what does the Fed do when there's inflation? When there's high inflation, the Fed raises the Fed funds rate. What the Fed funds rate is, what you can think of it as, it's really the shortest term interest rate. It's really an overnight rate. And that overnight rate helps us to think about longer term rates. And so what the market does is the market thinks of the 2-year rate, which is in red, as what the Fed funds rate is now and what it's going to average over the next 2 years. And so what you see, like, let's just take a look in your 2017 and 18, and you see the red line above the blue line, because it was saying, the market was saying, we think the Fed is going to keep raising the Fed funds rate. And the market was right. And the Fed funds rate kept going up. And then in late 2018, in the fourth quarter, the economy started to slow. And the market started saying, wow, the Fed's not going to be able to keep raising rates. In fact, they're going to have to lower rates. And you saw the 2-year yield come down, reflecting, yes, the Fed funds rate is higher right now, but it's going to come down. And they were right. And then, of course, we got to the pandemic and they took rates to zero, because they take rates low when they're trying to stimulate growth. When you make money cheap, when it's cheap for me to borrow money, then I'll buy a house or I'll buy a car or whatever people borrow money to buy. And what you see right now is that the 2-year yield is above the Fed funds rate, because the Fed is currently raising rates. And the Fed, what's called the FOMC, the Federal Open Market Committee, meets twice a quarter, about every 6 weeks, and they decide what to do with the Fed funds rate. Now, they can meet more frequently than this. They can have emergency meetings, but their scheduled meetings are twice a quarter. So the market is telling you that they expect the Fed to keep raising, raising the Fed funds rate. When you look at longer term rates, you can think of them in the same way. You can think of them as the Fed funds rate and what we think it's going to average over the next 10 years, and maybe what we call a little bit of a term premium, a little bit extra compensation, because I'm taking a risk by tying my money up for 10 years. But what we tend to see overall is that the 10-year interest rate, the 10-year yield, tends to be correlated with economic growth, nominal growth, meaning every day we get economic indicators. And when they tell us the economy is growing at a faster rate than expected, interest rates go up. The 10-year yield goes up. And when we hear inflation's higher than expected, interest rates go up. When we find out that we're growing slower than expected, interest rates go down. When we find out that inflation is lower than expected, interest rates go down. So that's the kind of thing that we see. That's how interest rates are set. That's a lot, but I would tell you, if you think about that and understand that, you know more than, honestly, 99% of the population. They just sort of hear what interest rates are, and they think that, oh, it's some mystical number that somehow is set by the government. It's not. The Federal Reserve sets the Fed funds rate. Everything else is set by the markets. The markets, investors are buying and selling and to determine these rates. One other thing to realize is that you have, when you think about the U.S. Treasury, as I said, that's risk-free. But not all, companies are not risk-free. Companies have risk. And what I have here is what's called a spread. the spread on riskier companies. We have bonds that we call investment grade bonds. Those are companies like IBM that are, pretty stable, that sort of thing. And then you have riskier bonds, what we call junk bonds. And junk bonds, since they're riskier, investors demand a higher return to invest in them. And so what this is showing you is the extra return investors need above the risk-free rate. And so look at what you see. When times are really bad, the shaded area was the recession with the pandemic. When people are really scared, they need a lot more return to invest. In other words, in addition to the risk-free rate, they needed another 10.5 or 11% to justify loaning money to a risky company. Why? Because in recession, when the economy is slowing, that's when those companies can default. Their business is slowing down. They lose revenue. In other words, customers stop buying from them. Then they can't make their interest payments. Questions about that? Any questions before I move on to sort of the current events? You can just speak up if you have a question, but otherwise I'll move on to the current events. All right. So let's think about what's going on right now in the markets. What's everyone watching? So I've broken this up into the economy, interest rates, and stocks. And then I also have a slide just to sort of encourage you to keep up. So, and how to keep up. So one of the things you might have heard about is that inflation has been really high. Inflation just means prices are going up. And so there are two main inflation indicators. Yesterday morning, we got the CPI, the Consumer Price Index, and that's the most widely followed inflation indicator. The Fed actually doesn't use that. They use a slightly different indicator, what's called the Personal Consumption Expenditure, or PCE price index. And they're a little different how they're comprised. And you can see that they typically move together. On average, the CPI is higher than the PCE. The CPI looks at this basket of goods and services that we buy. But that basket is really fixed, meaning they look at the basket and they say, well, people normally buy this much beef and this much chicken, and how did the price of that change? The PCE actually looks at what we did buy during a period, and that's harder to put together. But what happens is when the price of beef goes up, people substitute and they start buying chicken, right? And they move to cheaper goods, and so because of that substitution, what you see is the PCE is typically a little lower. We also look at other measures. These are what's called a headline number. A lot of people look at what's called the core inflation, where we strip out food and energy because those are really volatile. But regardless, the thing that you should see from this chart is, back when I was your age, I was born in 1964. And so, back when I was, you go to 1980, like when I was 16, look at how high inflation was. It was crazy. It was crazy. So I don't want to hear any of you whining about inflation. It was much worse when I was your age. But this is bad inflation. And so, the Fed wants to get rid of that. And so that's why the Fed is raising rates. One of the things that a lot of people have been talking about is the fact that, well, with these higher prices, people have a lot of excess savings, more savings than we would have expected them to have. And it's because of the pandemic. And a lot of people think that that's because the government sent people money. And the government did send a lot of people money. And that certainly had an impact. But the majority of excess savings don't come from that. In fact, most of the people in the higher income levels didn't get money from the government. The reason that people have excess savings is because we just didn't spend as much. I'm married, I've got 3 kids, and we normally go on like a summer trip every year. Well, in 2020, we didn't go on a summer trip. And you think about that, to, if we go away for, let's say, 10 days and, we've got 5 airline tickets and hotel rooms for, for all of us, and whatever we're doing, wherever we get to, you're probably looking at what, $10,000. Well, that was $10,000 we didn't spend. And then 2020, we didn't do it either. And so that's how people have all this extra money, is they didn't spend, and it doesn't have to be a big trip. They just didn't go out to eat, right? For a long time, you probably didn't go out to eat. The only, there were a few months where it seemed like all we did was, one of us went to the grocery store. In my family, we had this vote, right? Because we were really scared of COVID. Everyone was scared of COVID, and we didn't really know much about it early on. And, we had a vote of who should go, because my wife always went to the grocery store. But we had this vote of like, who's the least valuable member of the family, right, that we can send to the grocery. I lost 5-0. Anyway, so I did the grocery shopping during those few months. But that's what happens. That's why people have excess savings. They just didn't spend money. And so there's this thought that, well, people are going to be able to keep spending because they have this excess savings. I'm not sure that that's quite true. In aggregate, we have a lot of money, but it really just belongs to the people who are in higher income levels. And so, yes, they should be able to keep spending even with higher prices, but others maybe not so much. Why do we hate inflation so much? So one of what you have, a lot of you probably heard about the Fed chair. The Fed chairman is Jerome Powell, also known as Jay Powell. But we have all these different Federal Reserve banks. We have 12 different banks across the country. We're here in Austin, we're part of the Dallas district. But each one has a president. Each of those 12 districts has a president, and they often speak. And it's a great way to follow the economy and know what's going on, because you want to know what the Fed is thinking about, because they have so much impact. And so the Fed president from Richmond spoke last week, and he was talking about, why is it that we hate inflation so much? And he says, one reason is it just creates all this uncertainty. We don't know when to spend, when to save, where to invest. We don't know how much prices are going to change. Should I buy something now? Should I wait? Is it going to come down? I mean, think about cars. A lot of you guys are at the age when you're buying a car for the first time, or getting a car for the first time, and cars have become incredibly expensive. Used cars are incredibly expensive. It makes us uncertain. Should we wait? My son, I have a son who's 20 years old, and he has a car, and we were talking about maybe we should sell his car because he doesn't take it to college with him. Maybe we should sell it, hold on to that money, invest that money, and then in a couple of years when he gets out of college, hopefully car prices will be a little lower and he could get a nicer car. These are the things we think about. Inflation's exhausting. That you may come from a family, some of you probably come from families where upper middle income or upper income, and you don't really think about inflation that much. But for a lot of people, it really impacts their budget. And so they have to shop around and find better prices. When you work at a business, all your customers are complaining about higher prices. One of the things I always tell my students is become observant, right? Become observant. Get your head out of your phone and become observant. Watch what's going on in the world. Meaning, a good thing to do, one of the things I do a lot is when you see gas prices go up. Right now they've gone up. They've been coming down for the last month or so, or 2 months now. But one of the things to do is walk around when you're getting gas at the gas station and look at the pumps where people are done. And, it costs, whatever, $50 or more, when gas is $4 or $5 per gallon to fill up. And you'll see a lot of the pumps stopped at $25 or $30. That didn't fill someone's tank. They had a budget constraint, right? And so it tells you that this is impacting people, right? Because it doesn't make any sense to just put half a tank of gas in your car. You're going to use it and you're going to have to go back. But it does make sense if you don't have the money to fill it up. And so you notice things like that. And then inflation seems unfair. One of the things we know from doing studies is that everyone thinks whatever they buy has gone up the most, and so it's like my wife and I, we spend a lot of our money right now on college. My two boys are at private schools, and it's super expensive. But everyone feels like, oh, whatever I buy has gone up the most. Everyone thinks their personal inflation rate is higher. And so, those are some of the reasons why we hate inflation. Question becomes how high will the Fed take the Fed funds rate, or the federal funds rate? A lot of people call it, and I call it the Fed funds rate. It's officially the federal funds rate. But this is something, I just pulled this last night off, that you can, all you have to do is say Fed funds rate quote, or Fed funds futures quotes. And so this is a particular type of contract that people are betting on what the Fed funds rate is going to be. And all you have to know is approximately, there's a more precise way of doing this, but approximately what you have to do is just take this last price and subtract it from 100. And that tells you what people are thinking is going to happen to the Fed funds rate. So what you can see is, like, let's just look at March of 2023. At that point, investors think 100 minus 96.4, right? That's 3.60. So they think that the Fed funds rate is going to be a little bit higher than 3.5%. And so that's roughly how high right now markets think that the Fed funds rate is going to go. And, we'll see. It had been higher than that, the expectation, but it came down when inflation came down a little bit yesterday morning. When it got reported, people said, oh, maybe the Fed won't have to raise rates quite as much. We'll see what happens with all this. People ask, are we having a recession? One of the things that I learned growing up is that what practitioners tend to say is, when you have 2 consecutive quarters of GDP growth, of GDP shrinkage, of negative growth, that's a recession. And that's how practitioners define a recession. But officially, let me see if I forgot to put the slide in that I wanted, but officially, recession is defined by economists at something called the NBER, the National Bureau of Economic Research. And it's, for a lot of us who study this and think about this, there's no question we've had 2 quarters of negative GDP growth. Part of it is just that we've exported a little bit less because it's hard to sell to other countries that are having problems. Look at all the problems Europe's having, with Russia invading Ukraine, and Russia limiting the amount of gas that's being sent to Europe. Europe has seen a tremendous increase in their price of energy. Well, if I'm spending all my money on energy, then I don't have money to buy goods from the US, that kind of thing. So we've seen some things like that. We've seen some things with companies not investing as much in their inventory. But it's just hard for us to believe that this is a recession when the job market is so strong. And so, what you see is, a week ago, the first Friday of every month, we find out about our labor market. We get the most important report about jobs, the employment report, and we added 528,000 jobs, even though we were only expecting about 258,000. So the jobs market is much stronger. People have jobs, and we've replaced all of the jobs. We lost like 22 million jobs in the pandemic. We've replaced all of them. So we have a really strong labor market. And what you see is the unemployment rate is down to 3.5%. And look over time, in the last 50 years, we've really never been that low. And so that tells you, it's like hard to say we're in a recession when we have such a strong job market. One thing, though, that we're all worried about is the fact that what's called the participation rate is lower. You're participating in the labor force if you have a job or you're actively looking for a job. If if you're not looking for a job, you're not participating, you count as unemployed, that kind of thing. You have to be looking for a job to count as unemployed. And so what you see is we've had a drop in the participation rate. Now, the participation rate has been coming down over time, partly because baby boomers, the people born from 1946 to 1964, have been retiring. I'm the very last year of the baby boomers. So when you make fun of boomers, you're making fun of me, but I'm good with that. My kids are always saying to me, okay, boomer. I'm good with that though. What you see is a smaller percentage of people 16 and older are in the labor force right now. Some people dropped out just because of COVID, fear of COVID. Some people have long COVID, right? And they can't go back to work. Others have had to take care of kids. Most schools have gone back, but there's a lot less daycare available now. And so people have to stay home with their kids, or it's too expensive. It's not worth work if you're spending all your money with daycare. You've also had people retire. It's not that retirement. There was a lot of stories saying, oh, more people retiring. That's not necessarily true. What happened is actually when people retire, some percentage of them come back for two reasons. One reason is they are bored. Another reason is they don't have enough money, they realize. So what's happening is there are fewer people coming back. One reason people are coming back is because of COVID, or because a lot of work is online, and that doesn't solve boredom. That's still boring working online, right? So, but one thing we do think is going to start to bring more retirees back into the labor force is inflation. People are going to realize, wow, I don't have enough money, and they're gonna come back. Let's see what else we have. Oh, the next thing I'm talking about is interest rates. What I've done here, remember how I showed you the yield curve? Typically what happens with the yield curve is it's upward sloping. Short-term rates are low, longer-term rates are high. What I've done here is I've taken the 10-year interest rate, the 10-year yield, and subtracted the 2-year yield. Normally the 10-year is higher than the 2-year. When they're the same, it's at 0, that means. And right now the 2-year is higher. Take a look at this chart. Whenever it's gone below 0, which means an inverted yield curve, meaning short-term rates are higher than longer-term rates. Shortly thereafter, we had one of these shaded areas, which is recession. So yield curve inverted, we have recession. Yield curve inverted, recession. Inverted, recession. Inverted, recession. We had the pandemic, and now we're inverted again. Everyone's scared about that. Why does it invert? The short end goes up because the Fed's trying to slow the economy to get rid of inflation. And then the long end, the expectation of future growth goes down. And so that's what people are talking about right now in the real world. Show you a few other things about stocks. So here, what you see is this year, interest rates have gone up. They've come down recently, but since the start of the year, interest rates, as the 10-year yield, has gone up. Well, look at what happened to multiples this year. Multiples have come down, meaning how much people are willing to pay for $1 of earnings of companies has come down. And then recently they've gone up a little bit as interest rates have come down. That inverse relationship I told you about earlier. Interestingly, though, margins are still pretty high, or very high. Margins are, for every $1 of sales, how much earnings do I have? You would have thought, like, oh, with this inflation, isn't it going to come down? And the answer is no. Think about it. We've had 8.5% inflation over the last year. But what's my biggest expense as a company? It's workers. Workers' wages have only gone up 5 or 6%. So what you see is workers aren't keeping up with inflation. They're losing out. You get a 5% raise, but prices are going up 8 or 9%. You lost. You were worse off. And that's what we're seeing. But the companies are better off on average, not every company. But if I can raise prices 9% and only pay my workers 5% more, I won. And so that's part of what we're seeing. One of the other things everyone's talking about is estimates for future earnings are coming down because we're fearful that the economy is slow and people are going to be able to buy less with higher inflation. This is just showing you what I started by talking about, was what's going to happens with our returns. And you can see returns are a combination of 3 things. the change in multiple, your earnings growth, and then the dividend. And the dividend is sort of in red or pink, and it's always very small. But like if you look at the first quarter of this year, interest rates went up, so multiples went down, and that drove stock prices down. Recently, multiples have gone up as interest rates have gone down. And so that's what we've seen. A lot of people are talking about, are we in a bull market? Meaning a bull market means, the market is rising and going to hit new highs. Or are we in what's called a bear market? Bear market's when the market is 20% lower than its high, but a bear market rally. Just meaning that, yeah, the market's been going up recently, but it's going to eventually go back down. We won't know until after the fact, but that's what people are talking about right now. Finally, just because young people are interested in Bitcoin, I just want to show you Bitcoin tends to be highly correlated with NASDAQ technology stocks, meaning people speculate on Bitcoin. It's, we don't know its true value, but people speculate, and they, when they're buying risky stocks, they're buying Bitcoin and vice versa. I'll end just by encouraging you to keep up. These are some of the things that I read on a daily basis. But what I would tell you is, that's my job, is I follow the markets. I teach about the markets. I speak about them all the time. It's not your job, right? But you want to learn about it. And I would pick one of these, like whatever you like. And I would subscribe. They have student subscription rates, or most of them do. Barron's, I think, is the single best thing. It comes out once a week. I mean, it also has online that they put out stories throughout the week, but it comes out once a week. You can read it online. And the reason I'm a huge fan of Barron's is that the Wall Street Journal and Financial Times, which, I love both of them, they tell me about the news. Barron's tells me about how the market has reacted to the news. And I think that that's what students want to learn. Those are the connections you want to make. That's sort of what I teach all about. The Daily Shot is a really interesting service. They send, every morning I get about 100 charts about the US stock market, the economy, foreign stocks, foreign markets. It's really an amazing service. Anyway, that's some of the stuff I do and think about. I know that's a lot, especially for those of you who are new to this, but I hope what it does is just makes you think, I want to know this. It's not that you have to know this now, it's that you want to know this. One of the best things you can do if you want to learn about stuff like this is pick one of these things and outline an article each day. Just one. If you do that every day, and you do that for 365 articles, a year from now, you'll know so much more. And even though some of the things in the articles won't make sense to you, when you keep hearing it, eventually it will. And that's a lot of what I did, and that's a lot of how I learned. And to me, watching the markets and the economy, it's like watching sports, and it's like, I can't believe I get paid to do it. And so it's just an awesome thing, and it will take care of your financial future. So I hope this, maybe it didn't all make sense to you, but hopefully it encourages you to start following it. Tina, I don't know, we might have a minute or two for questions. I'm happy to do that. Or
I think we have 2 minutes. I'll just see if any question pops up. We do have one. What's a piece of business news in the last year that impressed you the most?
Let me see what what's a piece of business in the last year that impressed me the most? I as far as impressing me the most, I think that I guess I tend to, I don't know about impressing me. I think, impacting the markets, I tend to be a big Fed follower. So I think that impressed me the most. I think, one of the things that makes me feel good is to see, as far as just impressing me the most, is I've started to see maybe a change in how people view Elon Musk. I think, my students for years, they just love Elon Musk. I think there's no question he's brilliant, and the kinds of things he's done, just absolutely amazing. But I also think that, some of the other things he's done, sort of tearing down Twitter, making a bid, and then trying to get out of it, I think is pretty poor. So I think that's probably been something I've been happy to see, that people have been locked into their views, as polarized as we are, and have sort of switched their opinions there. Again, think he's a genius, but I think that's sort of probably what's made me think there, just that people have changed their views.
I have a question for you actually.
Sure.
So would you say a good way to practice what people have learned is paper trading? Because I've heard a lot of people like paper trading, just trying to practice what they learn. Do you think that's a good way to practice?
Paper trading is a great way to practice. It's not perfect, but it's a great way. Making decisions and realizing that stocks don't go straight up and that no one is right all the time is a great way. The other thing I would say is, right when you start making money, start investing, because the one thing you can't get from paper trading is the emotion. And we study something called behavioral finance, and it's we don't act rationally. I remember when I started investing, and when I would see my account go down, I mean, it was so painful. It's like, I worked so hard for this money and now I'm losing it just like that. I worked all day and I'm worse off. That's painful. You have to have this long-term perspective, and you have to learn how to deal with those emotions. And so paper trading is awesome. It's also, I would almost say, awesome to tell people what you're doing on that paper trading, because even just that reputational risk gives you a cost. And what you have to realize is you're going to lose money at times, and especially early on. And one of the worst things that'll ever happen to you is if you make money early on, because you're going to think you're a genius. And we all have good times and bad times in the markets. And so, but I think it's a great way to get started. But then once you start making money, use real money. Well, the funny thing is, like, I look back and how stressed I was when I was losing money when I started investing. And now you look at it when you get older, and it was like rounding error. It was meaningless amount of money, but it seemed really important back then. But as you get older, you obviously accumulate more. And then you look back and you're like, I can't believe I worried about that. But I did. And that's the only reason I was able to invest as I got older. So that's what I would say. How truly accurate are stock market predictions? And the answer is not very good at all. What you should do is watch CNBC and write down what everyone says. Some people are going to be right, some people are going to be wrong, and the people who are right are going to be wrong the next time. Like, it is a hard game to play. You're competing against the smartest minds in the world, or some of them, because there's so much money at stake. Everyone wants that money. And so to think that you can just beat them, that's a hard thing to do. Should I not listen to anyone who claims that they can predict oil prices? Oil prices is an interesting market, and the answer is that, again, no one's going to be perfect at predicting oil prices. You can see the huge swings that we've had in the last 2 years, and even just in since March and since the invasion, we've had huge swings, and people saying we're going to 200, and then we're back down to 90, and then people, we start back down to 90, and people are saying, oh, we're going to get to 70. People tend to tell you what's happened yesterday, but people are studying the supply and the demand, and things change. The supply issues have changed. We thought we were going to lose a lot more Russian oil than we have. A lot of it's made its way to the market. Demand, we think, is starting to weaken now because of weaker GDP. When the world economy is growing at a slower rate, we consume less oil. But there are other things also driving it up, and so these are things we do with everything. There's no way to tell you exactly what's going to happen. Who makes money is the people who make the best predictions, but you also have to be able to understand you're not going to be right every time, and that's what we do. And we shouldn't expect anyone to be right. If we always remember when someone got it wrong, then we don't listen to anyone. You want to be able to listen to everyone's views, take it in, and form your own view as to what is your best opinion.
All right. I think that's all the time we have for right now, but we want to thank you, Mr. Leeds, for coming and speaking to us, because this was just an amazing speech.
You're very welcome. Let me say one other thing. I meant to put on here and I didn't. And Harrison, you mentioned this earlier, sandyleeds.com, SANDYLEEDS.com. It's all free. It's the notes we use in my class about current events. If you go there, you can sign up for an email that comes out every Sunday afternoon at 4 Central Time. You will get an email after you sign up that you have to open up, and then you have to click on the link. Otherwise, it will never get to you. And if you use Gmail, that email probably has gone to the trash or junk file. And so you have to go pull it out, bring it into your inbox, click on it, then you'll actually get it. But if you don't get the email on Sunday afternoon, if you sign up, that's what it is. I don't look at who signs up. It doesn't faze me at all. I don't care. But if you're interested, that's a good way to keep up too.
I'll send a link in the chat. So everyone could just click on it. But thank you so much, Mr. Leeds. I know you're a busy man. Your time is precious. Just really appreciate you coming this morning to speak to us.
Great. Well, good for you for putting this all together. And thank you so much for including me. I hope you guys all enjoy the rest of your conference.
Thank you so much.
Thank you.
Stay in touch.
You too. Thanks.
So everyone will be on here. We'll take a break for the next couple minutes, and we'll be back at around 10 with Mr. Guard. You can go to the website and check out his bio if you want to read before he gets here. We're going to turn our cameras off and just take a break for a minute, and we'll be back. Okay, welcome back, everyone, because it's 10:01 now, and we're going to get started. Our next guest speaker is Mr. Frederick Guard. He is the CEO of Grayburn Vision, a public company listed on the NASDAQ Stock Exchange. He has tons of experience running private and public companies around the world, so we are delighted to have him speaking with you all the way from Greece, where he is right now. So thank you so much for joining us, Mr. Guard.
It's actually amazing the technology works. I'm actually on a boat now sailing, and I have enough Wi-Fi to to talk to you, which is quite nice. Yeah, no, thank you very much for having me again. I think we wanted to cover a few things, and I intend to maybe speak for 10 minutes or 15 minutes, and then take your questions if you have any, if that's fine with you. I think the topics of interest today were around IPO, not only how, but maybe why would anyone want to go public then maybe I will cover other ways of getting access to capital, such as merger and acquisitions, business development and licensing, or simply partnering some of your technologies with somebody else. So maybe to start with the IPO, please interrupt me anytime if it's not clear, or if you have any questions. On the IPO, the question is, why would anyone want to become a public company? And the answer is very often it's all about money and access to capital. You've created a startup. It has grown over the years. You've raised a number of rounds of private financing, and either you need to go to some sort of liquidity event for your investors. Most investors in private companies have funds that have a certain life, and that, but very often, you know, it's 5 years, 7 years. Maybe for some, it could be actually a bit shorter. So at some stage, these people want to get some of their money back, and even if your valuation as a private company goes up, their participation in your company is not something they can trade. You can sell it. I mean, there's a market for private company ownership, but certainly it's not as easy or as liquid as being on the stock market, where you can, by pressing a button, it's not that simple if you own a lot of a company, but if you're a simple shareholder, you can buy, you can sell shares. It's actually very simple. So some of these people at some stage want some of their investment back, and then they would ask you to go public. The other reason to go public is, and there are probably many others, but one of the main reasons is the development of your company. You will need a lot more money in the years to come, and the public markets are a very easy way to raise a lot of money. And this is why most of the largest big companies in the world are public companies. There are very few, there are some, but very few large private companies, simply because the capital needs are such that being on the public market allows you to raise capital more easily. So you can actually IPO, and you organize, you could org up, you find banks, you find lawyers, you find the right team to go public, and then you do your IPO. So the pluses of an IPO are very clear. It's a very good way to raise a lot of money. Your investors can buy more or sell more if they want to realize some profit. During the IPO process, you actually attract different type of investors. So it's enlarging your investor base, and therefore your ability to raise money quickly. And it's also, the day you have new data or new products or any sort of news, you can raise money in a matter of days on the back of such an event. So you can raise more money very, very fast. But it comes with some obligations. You get into this infernal cycle of quarterly reporting. I don't know if you've seen, we are now in a quarterly time. So you have all the 10Qs of all companies being posted and reported by the financial analyst. So you have this quarterly obligation to tell everything that's going on in the company. It's all public, so you cannot hide your plans to your competitors. I mean, you can hide some, but not all. So you need to disclose an awful lot of what you're doing, and therefore it's all out there, and people can see it, monitor it, and keep you accountable to deliver these plans. It requires a lot of governance. You need a board, and that board needs a certain number of independent board members. And you can't do whatever you want in terms of remuneration, in terms of auditing the account. It's all very, very legalized and structured. Your company is public, so you don't control the price. You know, it's suddenly you're exposed to all sort of macro events. Recently, you've seen the stock market has gone down significantly because of things that are not really in the control of companies. You know, inflation, war in Ukraine, all sort of things. COVID-19 a couple of years ago. Those things are not a function of how a company is doing, but this overall sentiment or feeling in the market can significantly impact your price and therefore your ability to raise money or the amount of money you can raise. And that's not something that is in the control of anyone. It becomes out of your control immediately. And then finally, there is something about the cost of being public. So if you are a small startup, you can do an awful lot with the money you have. When you're public, you need to contract insurance, you need lawyers, you need auditors, and that adds up in millions of dollars every year. So there is a huge cost in being public. So those are the inconveniences of being a public company. So that was to cover the IPO, the IPO piece. But there are other ways of raising money, and what most smart companies do is try to raise what they can, but you know, not too much. And then find alternative ways that are not dilutive or that are different. So there is all sort of, you know, funding that is totally not dilutive. So grants are great. Normally, if you can get some, you can actually you know, get money without any sort of obligations. But normally, you have to transact some of your companies to get access to this capital. And this is where partnering and business development comes in. If you're in a company working on a technology, sometimes finding a larger company that would potentially have an interest in your technology and co-developing that technology together, or that product together, or that business together, could make sense. So, for instance, if you're working on a product that needs a vast distribution network for selling this product, you can maybe partner with someone having a distribution network. And this company might actually have a vested interest in investing in your company or get some sort of share of this company. And then that provides you with a reduction of your cost, because you co-develop, you share the cost, and then you can benefit from the distribution network of this other company. you can out-license some of your products. Some of your products may not be in your strategic plan anymore. For some reasons, you may deprioritize some of them. Or maybe they are, but maybe there are people out there that are also interested by these products for different geographies. So for instance, if you're a US-based company, partnering with a China-based company may make a lot of sense. You suddenly have access to the China market, which is very hard to get access to. And these other companies, this Chinese company, may give you royalties, may give you milestones, may give you a cash upfront that may help you to develop the product for the US. So there are kind of win-win situations where partnering or business development may make sense. And finally, there is merger and acquisitions. You can certainly be acquired. I mean, this is the most interesting exit for any founder of a company. Someone comes, buys you out, all cash or a mix of cash and shares or stock, depending on the way the deal is constructed. And that is clearly the best way. But you can also acquire technologies that may provide some synergies. And with these technologies or these companies you can acquire, maybe will come some new investors that you don't have, that will expand your investor base, bring the cash of this other company, bring more technologies, and make your company stronger. So I think IPO is of course one way of getting access to capital, and that's the most famous and the most visible way. But there are many other ways, and that's what I wanted to convey with this rambling talk on partnering and business development. So I don't know if you have any questions or
So if any of y'all have any questions, please post them in the Q&A section so that Mr. Guard can answer. I have a question actually. If someone wanted to work, say, in investment banking on IPOs or M&A work, what would be a good thing to study in school or in college for people that are looking at college right now?
Yeah, so it's actually interesting because you find people with all sorts of backgrounds. You have people with a more finance background from start, but you also have people with business background, engineering background. So I don't think there is one path only, but I think certainly, and so you have medical doctors. In my field, for instance, you have bankers that are actually MDs or PharmDs and decided at some stage that it was not necessarily what they wanted to do. I mean, to be in contact with patients, or they wanted to be more on the financial side, and they are one day deciding to maybe do another training in finance, and then they go into banking. So I don't think there is one path. I think there are multiple paths. I think you need to follow what you are. There are two philosophies. You either follow what you are very good at, or you follow what you are very passionate about. I tend to think following what you are very good at is a good idea, because you need to find a way to differentiate yourself with others, and passion is not always the best way. Maybe it's just being excellent in what you do. So whether you're going to study engineering or science or medicine or finance, I think you can at some stage go and go into banking.
So it looks like we have another question in the chat. What types of companies are the easiest to gain a large IPO?
Sorry, say it again. What type of companies?
What type of companies are the easiest to gain a large IPO?
So, I mean, normally the larger you are as a private company, or the more revenue you have. So when you see these massive IPOs like, Uber or Airbnb or others, normally these are very high numbers because there is an existing business. The investors can really understand the cash flow and or the promise of a cash flow, and it's de-risked because the technology works. So the companies are, I would say, mature and have some sort of metrics that investor can understand very well. These are normally very large IPOs. If you're early stage, or if you're in a risky business like biotech, my industry, where you never know which way a clinical trial is going to go. I mean, it may be positive, maybe negative. I mean, just the way science works. Sometimes you win, sometimes you lose. That's just the way. Then, of course, the valuation of these companies come at a significant discount because of the risk. So I would say, if you are very large, country-controlled oil company, you may have a massive IPO. If you're a early stage tech company, it may be smaller.
Another question is, sorry, let me get the Q&A. What's one piece of advice you would give to students who want to run his or her own public company in the future?
Oh, that's a good one. I don't know. You need to. So it's really hard because I mean there are many public company CEOs, but when you make it an objective, you may not necessarily make the best decisions to get there. I don't know if it should be an objective. I mean, it could be an aspiration, but I think your primary objective would be to either create a new business that is making sense, or learn how to run businesses very well. Most CEOs of public companies actually are not the founders. The founders go away at some stage. And normally when you go to public companies, I mean, there are exceptions, of course. Facebook is one of them, or Tesla, for instance. But normally there is a change in management at some stage. So most public company CEOs are good business people. You know, they've run businesses in the past. And one day, you know, they get the chance to run a public company instead of running private companies. So my advice would be learn how to run a business. Work for companies that are going to develop you, that are going to give you responsibilities, allow you to take risk, allow you to fail, and learn from your failure, and learn to run the business. The other aspect is you never run a business on your own. You need to become a leader, or a manager first a manager of teams and a leader of teams. So anything related to leadership is very important, and that's one of the key criteria to get these jobs, is to have demonstrated you can run large teams, you can drive performance, but also you're a good person, you're a good leader. Someone people want to follow. It's not all about the technical skills, also about the soft skills. And these take longer to acquire than technical skills. So that's what I would say. I would say, run teams, run businesses, and then maybe, if you make the right choices, you will be a public company CEO. I mean, there is no magic about it. I mean, it's not, you don't need to be, superhuman to do it. I mean, it's just a normal job. But I think take the time to build the foundations to get there, and don't rush necessarily, cut corners. You see it very often. These founders, they have a good idea, they want to keep on running their business, and then they fail. And you need to and then these companies bring on board experienced leaders, because this is what needs to be done at that time for the company. So take the time, build your skills, and you'll get there.
I think we have two questions. First, is there any one way to truly gain intrinsic value aside from getting investors?
So gaining intrinsic value outside of, so I didn't hear the question, sorry.
Is there any one way to truly gain intrinsic value aside from getting investors?
Oh yeah, I mean, certainly. I mean, if you advance your, I mean, the value is normally a function of your either the promise of future cash flow or your existing cash flow. So that's the best way to to actually gain value is, I mean, investors are going to, compare the potential investment in your company as opposed to other companies. So if you run a biotech company, for instance, then the same investors will invest into tech companies, food companies, and so on. So, it's how you stack up in terms of your potential for income. So income or being acquired, if there is an exit, if people think you're going to get acquired, then suddenly your value goes up. So the intrinsic value of the company is your ability to tell the story and your ability to demonstrate you can execute on the story, whether it's sales, whether it's research and development or something else. So that's how you build the value, is by progressing your business one way or the other. Then the investors follow, and that's how your price goes up.
Great. We have, it looks like one more question. Could you share more about your journey on why or how you took on the path of running a public company?
Yeah, so I was working for a large multinational before, and so I had a $6 billion business, and as part of a much larger company, and I was in contact with a lot of entrepreneurs because I was acquiring small companies at that time for that job. And I became very interested to learn about their stories and just to understand what they were doing every day, which was very different to my life. I was in a company where we had a lot of money because it's a large multinational, and we are spending a lot of time working on operations, working on commercial plans, forecasting, but we were never worrying about raising money. The money was coming because of the profit of the company. So I became really interested to understand their stories and how they got where they were. And I started to network with investors as part of me acquiring some of these businesses. And one day I decided that I didn't want to keep doing this work for a larger company. I wanted to go for a smaller team, simply because I had, I think, done enough, and I worked in multiple countries on multiple different businesses, and I thought, it was time for me to do something where I would feel my a bit more important. If you work for a company that has 100,000 employees, I mean, you can be a genius, but for most people like me, you have some impact, but life of the company that has 100,000 employees, where you join a company where you're only 25 or 30, certainly everyone has a much larger contribution because it's simply, there is no place to hide. It's very small. So I decided to go for a much smaller organization. And when I joined my company, we were private. So there was a plan to go public, but it was a private company. So we only did the IPO 3 years after I joined. So that was not done until I went there. So that was the story. It was for me changing career in some ways, going from running something very large to running something very small, but feeling more in control and more in charge than before.
That looks like our last question. I have one last question for you. In terms of opening an IPO for a company, would you say a good rule of thumb is to hold off on opening an IPO as long as the company is healthy, or until you need the capital? Or do you think you can open an IPO for just because you want to open an IPO, not because it's necessary for the health of the business?
Yeah, right. So there is a rule here, which is you should never look to get money when you need money, because you do it from a position of weakness, and if you do it from a position of weakness, people are going to take advantage of you. So as weird it may seem, you should always look for money when you don't have the need for money, and you need to always, I think, take as much as you can, because you never know what's going to happen in the markets. One day the markets are good and the next day they're not. So that would be my advice: is not to take money when you need it, but to take money when you can. Then when do you do it, and when do you start not to do it? It depends on the feedback you get from investors. So before you IPO, you go through a process called testing the waters. And that process is basically you tell your stories to investors, and you basically ask them, do you have any interest? In case we do it, do you have any interest? And the bankers will work out at what price. And then you may decide to go or not to go, to do it or not to do it. So there is a process to actually test interest before you go public. But the fundamental rule is don't wait until you need the money. Always have more money than you need.
Well, that's amazing. That's great. We have, actually, we have one last question. Sorry. Any advice on finding a good team for a startup company?
That is probably the most difficult thing, is finding people. I think networking, talking to a lot of people is very key. If they're around people you trust, you can ask them if they know people that are willing to join your company. This is the most difficult thing. It's always the people, because the technology, sometimes it works, sometimes it doesn't work. You can always buy a new one, but the team is really what makes the difference, and that is really, really hard. So I think being experienced in a certain sector, knowing what to look for, or surrounding yourself with people that know what to look for, and this is so that's another aspect of things. It's even in a startup, you may want to staff your board with people that are not only investors, that people that can help you with these questions. For instance, if you have on your board people who've run similar companies in the past, or still running similar companies, they may help you. They may help you to interview, they may help you to select, they may help you to design your company, so that you don't make mistakes. And mistakes are really painful. They're painful because they cost a lot of money, and they're painful because you waste an awful lot of time on bad people. If you hire someone that's really not good, it can actually destroy your team, it can destroy your company, and you will spend a lot of time correcting that as opposed to focusing on driving the business. So people matters are really, really important. But you can find people to help you. And you can bring these people on your board.
I know that you alluded to it before, but what are some specific pros and cons of going public?
As I said, the pros are really about the easiness to raise money in the future. So that's the biggest reason why you would do it, is if you are reaching some inflection point and you think your valuation is going to go up, you can raise an awful lot more money than if you're not public, and much faster. But beyond that, it's just a financing tool. There is no reason why you could not stay private. And some very large companies are private, and they are doing extremely well because they have good investors, access to capital, or they make a lot of money and they just self-fund and invest their own money. So that's the only reason why you would do it. It's just a financing tool, but that's it. It's nothing more. So the reasons not to do it is if the timing is wrong. So if for instance you don't expect news in your business for a very long time, public investors don't like that. They want you to go public, and then within 12 to 18 months, they want to see some sort of inflection point. They don't want to sit on this dead money for too long. If they invest in your company at whatever $10 a share, they want to see the stock going to $20 a share in 18 months. And if you don't have any news and nothing planned, it's unlikely to happen. That your price will go up. So the timing may be a reason why you don't do it. And then I said before, the cost as well. It's very cumbersome. You need a board. You need directors and officers insurance. This is now millions of dollars every year. You need auditors for your accounts. They're very expensive. They're kind of Ernst & Young and PwC type of people. They're very expensive. So there are multiple reasons why you would not do it. But all in all, big or promising companies go public because it has more benefits than drawbacks, and that's why we try to do it.
Well, excellent. Excellent. It looks like we don't have any more questions. Give it a last couple seconds or a minute to see if anyone has any more. So it looks like we're done with the Q&A session. We want to thank Mr. Guard for coming and spending some time when he's out in Greece speaking to us. Well, thank you so much for spending some time with us.
No, you're most welcome. I'm actually surprised the technology works, but it's you can work from anywhere now. This is really really interesting. No, thank you very much for inviting me, and I wish you a very successful end of the day. And thank you very much.
One fun question on my side. It's just a fun question. Is Greece worth sailing to?
Where I can see look at this. It's actually quite nice. We're sailing around islands south of Corfu. That's what we're doing now. So that's why I am.
Well, it sounds perfectly lovely.
Yes. Listen, thank you very much for inviting me.
Well, thank you so much for spending some time with us.
Take care. Bye.
Enjoy your vacation. Thank
Bye-bye.
you so much. Bye. Welcome back, everyone. We have Ms. Joseph Mccormick here. She's a venture capital. She manages Well Basin investment firm. And then she's also greatly supporting the Austin entrepreneur community. And we really appreciate you being here, Ms. McCormick. Thank you so much. Yeah, just add on anything if I miss anything.
Sure. I can do a short introduction if that would be helpful. Again, as Tiana said, I'm the managing partner of Wild Basin Investments in Austin, Texas, and we are an early stage venture capital firm. And we're a little unusual in that we have a non-traditional firm, and we also invest other venture capital funds. So although I spend most of my time making direct investments into companies, we also spend time talking to other GPs in other venture capital firms and making investments in those firms. So the way I structured this is just to sort of do an overview of sort of the history and the philosophy a little bit behind the type of investing known as venture capital. So, as we go through the slide deck, please feel free to ask questions in the Q&A. I'm hoping that if I don't see it, Tiana or Harrison will let me know that there's a question. So I don't know, you want to just start paging through the slide deck? Sorry, I'm not in control of the slide decks. So this is sort of an overview of the history of venture capital, and it's certainly it's a type of investing that is relatively new in the investing world. But I think what you can see from this is that really around in the 1960s, people started to get really interested in making investments in some of what would become some of the largest technology companies. And so you see in 1968, this NM Electronics was founded. That became Intel. And Kleiner Perkins is, if you know anything about venture capital, it's a very well-known firm. It was founded in 1972 with $3.7 million fund, which if you think about it now, that's maybe the size of a seed round in one company, not the size of a fund. Sequoia Capital is also one of the largest venture capital firms and most successful, and that was founded in 1975. For those of you in Texas, Bill Gurley is a Texan and a very, although he works in the West Coast, and formed Benchmark Capital in 1999. So it's relatively new in the investing world and has mostly been focused on technology companies. Go ahead, move forward. Okay. Venture capital is invested into companies that can grow really fast, high growth potential, and hopefully the ability to become very large. So that means they need a very large market they can address. You know, what people really tend to think about this is, think of Google is just becoming an enormous company, and there was really not a limit to how big that company could get. It's a subset of private equity, which just means investment into the equity of private companies rather than public companies. And venture capitalists invest very early in a company's life, long before you know whether the company actually is going to succeed. And therefore, it's high risk. And since it has a high risk, should have a high payoff in terms of potential, potential return on investment. Most venture capital firms will try to underwrite or believe that any company they invest in will give them more than a 10x return. But as it is, the most successful venture capital companies have giant returns for their investors. And we're talking 30, 40, 50, 100 times the invested capital. But that's very much an outlier. Those are the most successful companies. Most venture capital companies actually don't return capital and don't succeed. And then there's obviously a lot of outcomes that are in the middle. But if you're a venture capital firm and you're making investments, you're trying to really go for companies that are going to give you a 10x or greater return. There's also a huge emphasis on the founding team, because really, to be an entrepreneur is very difficult. You really have to stick with it. And so venture capital investors really care who is the founder, what is their skill set? Is there more than one founder? Can they endure the trials and tribulations of being a venture, the founder of a venture company? And also venture capital is the payoff for a founder or an entrepreneur is in their equity stake. And so this is the venture capital takes minority stakes in a company. There's different protections that the investors have, but they don't own the majority of the company. And so that's another reason people really want to have a good relationship with the founders. And obviously, there's a lot of different kinds of venture capital. Tech gets the most, but I want to give an honorable mention to life science, which is an area that has also been just hugely, it's hugely important to have venture capital coming into life science in order to make advances there. So this is a sort of, if anybody reads the paper, it'll talk about private equity. And like I said, venture capital is a subset of private equity, but I want to make a distinction between what is usually called buyout. And buyout, as it may, the name might imply, means that the investors take a controlling stake in the company. They buy more than 50% of it. And then those investors are really controlling the fate of the company, and they are hiring professional management. These are usually larger companies, lower risk, and there's a lot of different techniques that are used by private equity and buyout firms, a lot of financial engineering, a lot of debt placed on the companies in order to make a return. VC is kind of although it's also private equity, it's a different game. 2021 was a record year for VC and growth investing. And you can think of growth investing as sort of the grown-up cousin of VC investing. Typically, buyout is very many times the amount of money per year than VC. But in 2021, VC and growth were 82% buyout. And it was a record year, and there's been a giant pullback from that record year in 2022. The thing to know right now is that most of that is driven by the pullback in the public markets, because the public markets tell you how your company might be valued ultimately. And when the stock market falls, the implied valuation of the venture capital companies also falls. This is just a slide on who are the investors in venture capital. At the very early stages, this is angel and seed stages. A lot of it's wealthy individuals, people who've been entrepreneurs and been successful, family offices, which are private pools of capital owned by one family, sometimes some corporate VC funds. And what that means is a large corporation will set aside some of its internal capital to try to support companies at the early stages that might grow into something that they would like to buy. And then there's incubators and seed funds, people who really incubate. Incubators mean that they're organizations that help a company grow and get what it needs. And the seed funds are specialists and very early. Then where I sit with Wild Basin Investments is called early stage. And that's usually a Series C or Series A. And there's a lot of firms here. You still have participation by angels and family offices and strategic investors. When you get into the later stage, these companies are usually they have a higher valuation, greater than say 100 million. That's where you're really going to have just institutional funds, VC funds, growth funds, sometimes private equity funds that are doing a VC investment, even though that's not really their main type of investing. And more recently, hedge funds and really large institutional investors, think Fidelity or other huge almost bank-like institutions that have gotten into venture capital investing. So I wanted to just go through quickly the life cycle of a typical, if there's not really a typical VC company, but usually there's a founding team, either one person or several people, usually more than one. They form a company just by making, going to their state secretary of state and forming a company. Usually they're Delaware companies, but that's maybe, that's a more advanced topic. The founding team own the company. They might get some seed, some investment from friends and family. This is one, I'll just make a note. This is one of the barriers for diversity in founding teams, is that because of sort of the unequal distribution of wealth, not everybody has a rich uncle to give them a little seed capital to help them get started on their entrepreneurial journey. But that has traditionally been one of the places the first money into a VC company has been, the family and friends who believe in the founding team. There's also advisors. People get excited about the idea and they might contribute their help to the company in return for a small bit of ownership. Incubators and accelerators are slightly different. Incubators tend to take the company in and provide a lot of resources, and accelerators do the same thing, but they're usually a very compressed time frame. It's almost like running through a course on how to get your company up and started. And usually these types of organizations take, again, equity in your company in return for helping. And then after you sort of have an idea of what you're doing as a founder and you think you have a business, that's when you might be able to raise money, pre-seed or seed capital, oftentimes in a note that will convert into equity. These are other terms you might hear: seed round, Series A. All this is different stages in the maturity of a company. So in a seed round, companies should actually have a product and some paying customers. And these are early stage firms and angels. And once the company has gotten a little further along, that's when you hear Series A. And if a company is raising a Series A, they really should have, there should be some indication that this could really be a very successful company. And $5 million is about the lowest at this point you would see being invested in a Series A. So there's usually venture capital firms, and people are putting, their faith in the company and the founding team, and coming on a board and working very hard to be, as they're aligned to make the company successful. And since venture capital companies lose money in order to grow faster, venture capital companies have to keep raising money. And so that just goes down the alphabet. As they get closer to running out of money, they have to go back to the market, and hopefully they can convince people that they should be able to raise more money at a valuation that's even larger than the last time they did it. You'll see some data later on in this presentation about mega deals. And I just want to say, if you go back one, Tiana, sorry, this is the later stage deals. No, well, go all the way back to where we were. Sorry. Later stage VC. There we go, right there. Later stage VC used to mean just somewhere down the alphabet a little bit. And then we've had in, I'd say, the last 8 or 10 years, things called mega deals. And that's where the private markets valued these companies so much, so highly, billions and billions of dollars, that the venture capital companies were raising rounds that were huge, 500 million, sometimes more. And these mega deals were really outside of the capability of the venture capital investor infrastructure. And that's where you had banks and other hedge funds and people with a lot of capital to deploy come in and do those investments. Before, companies would have had to be sold or go public. And so people have really been watching the number of what is called mega deals to see about the health of the venture capital industry ultimately, because if that trend dries up, companies will have to find another way to exit, and which exiting is the only way that the venture capital investors are going to actually get their money back. You can go on. Things to know about venture capital. What's a VC company? Has to have large market potential. Some funds have a model that they are only looking for companies with giant market potential, huge, that can become the next Intels, Googles, Microsofts, etc. VC companies, as I've said before, they lose money. This is very important to remember. VC companies are not profitable. And so because they're not profitable, they're always hungry to have more investment so that they can keep growing. And most startup companies will not succeed. If you're a venture capital firm and you make 10 investments, you're hoping that 1 or 2 of those is wildly successful, and 3 or 4 of them are decently successful, and the rest of them you are assuming are going to be a loss or a total loss. VC is definitely, there's a lot of mythology, and I would caution anyone who's reading a lot about VC. There's a lot of people with strong philosophical opinions about what VC is and how it should be conducted. And there's a lot of mythology about, Harvard dropouts and hoodies and so on and so forth, or how, we have some of our very successful entrepreneurs with really big personalities that tend to be doing interesting, sometimes wacky things. Most of what is going on is not like that. Most of it is people working really hard to build a business that in an industry that they've spent a lot of time doing research in, and are working very hard, and they are trying to create value and ultimately wealth for themselves and their investors. But there's a lot less flash about it than you might think if you were just reading the paper. And it is not easy. Being a founder is not easy, and being a successful venture investor is not easy. I also wanted to mention, and this is on this slide, the diversity within the venture capital industry is is a pretty sad state, really. And to be honest, private equity in general is not doing a whole heck of a lot better. But there's a lack of diversity in the founding teams that get funded. And I think this is a result of the lack of diversity in investors. Women receive a tiny percentage of VC dollars. Black founders receive a tiny percentage of VC dollars. It's a problem for the industry, and the industry knows this and is trying to address it. But I don't know. Things are getting better, but very slowly. So why work in venture capital? If you're thinking about you want to be a venture capitalist, it is a ton of fun. That's what it is, really a lot of fun and intellectually challenging. It's very fast paced. There's a lot of really interesting, motivated people. Like any industry around where there's a lot of pressure, and some people become venture capitalists because they hope it'll make them very wealthy, and some people because they're fascinated with early stage companies. But if you like small companies and founders and founding teams, it is really rewarding to be able to work with those people and try to solve problems and find a way to have a successful business. These are some charts that sort of just got pulled off the NVCA website, and that's the National Venture Capital Association. And for anybody who's interested in finding out more about what's going on in the industry, they have a lot of really useful information. I think the take away from this slide is, like I said earlier, 2021 was a pretty remarkable year for venture capital. This is deal activity, which you can see has been going steadily up as venture capital has entrepreneurial companies, particularly tech companies, attracted more and more investment. But 2021 was really a crazy year. And if you recall what happened at the end of 2021 and throughout the year here so far in 2022, is you had a real drawback in the stock market. And that has really affected what 2022 looks like as opposed to 2021. However, and I'm going back to these mega deals, one of the things you watch is, well, where are these mega deals? Where are these? Are people still confident that they can invest a giant amount of money in a private company, which is probably not making any money, and hope that they can exit through an IPO, which is what's happening with a mega deal? And perhaps surprisingly, you can see that they're on par with 2020. Which was, at the time seemed like a huge year for it. So if you sort of erase 2021 from this chart, you can see that in 2022, we're still having a ton of those deals. So the private markets are still responding favorably to these type of companies. The reason that matters for the early stage investors is that you're buying into companies with a presumption of how they might return capital to you when they're very small. And so seeing the behavior of the public markets and the much later stage investors that might come and buy out your shares really affects how you might value your company early. You can go on to the next one. So this is about seed deals. And again, we always want to track, well, how many new companies, how many little companies are getting funding, because those are the companies that are going to turn into the larger companies, and they're going to be doing the Series Bs and the Series Cs and on down the alphabet. And there was a lot of fear earlier this year that maybe that sort of activity would draw back. But perhaps surprisingly, perhaps not, that although there was sort of a slowdown in the beginning of the year, it looks like we're on track to be at the 2021 highs, which is interesting. We'll see if that continues over the rest of the year. These are just some more charts. Median seed size. This is talking about what is the size of the round. So how much money does it take to support a company at what stage? And so you can see that over the last 10 years, the amount of money that a seed company would raise, and by seed, sometimes there's hardly any revenue here. There should be some customers, but these are companies that are very early, has been going up and up. So if you have to go find people to give you $2.5 million in order to get your company from barely there to something that has some customers, that's an indication that it's gotten more expensive, not less, to do that. And there's it should have gotten less expensive in terms for tech companies, because a lot of the tools that you need in order to build a software product have gotten a lot less expensive. But the amount of money it takes to hire talent, and the amount of money it takes to do just basic beginning marketing, all of that has gone up. And so companies need to raise more money at the beginning stages. You can see some of the late stage, it says late stage sizes begin to fall. You can see those dots are for 2022. And that is really interesting, because it shows that maybe people are requiring companies to be more efficient at the later stages, not just dumping a lot of money into them. And the same thing with valuations. The valuations are coming down. The amount of money people are raising is coming down. Okay, we can go on to the next one. And this is just sort of a snapshot. Now, I'm in Austin, and you can see Austin is this tiny little sliver, but at least it's on the chart. The Austin early stage market has actually grown a lot, although it looks like a tiny sliver on here. We don't just invest in Austin, though, and one of the reasons for that is that you can see that the Bay Area is still definitely the dominant place for venture capital markets, followed by New York, followed by LA. And LA is actually taking on a greater importance. Both a lot of investors move to Los Angeles, some of them from the Bay Area to get out of the Bay Area. And so it's I think going to be increasingly important. And Boston is always on this list. Boston is the absolute center of life science investing, life science VC investing, and continues to be. There's so many research institutions located in Boston and Cambridge that really it's still very dominant for that. But if you are thinking about growing up and becoming a venture capitalist, chances are likely that you may need to, at least for part of the time, reside in one of those named markets there. This is, it says here, 2022 not keeping pace with 2021 records. And I think that's very unsurprising. You can just, again, to think about for overall trends is 2021 was off the charts, and we're going to have some probably reversion to what was the previous trend. And there's a little bit here too, which is as the venture capital market draws back, unfortunately, you can see that the proportion of there was some data about female founders and how much capital is going to those companies. And you can see that it was going up, that's nice, but has fallen back down, at least for 2022. That's the market sort of shifts. This is again, there was a lot of the stock market had historically high valuations for tech companies. So a public company whose revenue was say 10 million would be getting it was remarkable how high the valuations were in the public markets. And that was based somewhat on revenue size, but mostly on how fast they were growing. But that has reset. In other words, investors have decided that those companies were overvalued. And as those multiples went down, so should the multiples that are given to companies before they're public. And that's what you're seeing. Yeah, we can just, if anybody has any questions, we can just stop on this slide. This is probably a little hard to see over Zoom, but if anybody has any questions, I'd be happy to answer them, or I'd be happy to keep talking about what specifically what makes a good venture capital investment.
I think we have one, or actually two.
Yeah. So I see, what qualities do VC investors usually look for in founding teams? And what types of teams do VC investors usually like seeing? That's a really good question, because I think that looking at the team is one of, it's more art than science sometimes, but it's really an important determinant of whether a company succeeds. You want to look for a founding team that has relevant experience in what they're trying to do. So why did this team pick this problem to go after? Do they have previous experience in that industry? Have they studied it? How knowledgeable are they? Do they have the right professional background, not only for the industry they're approaching, but maybe even for the business model? For instance, if you are trying to solve a really technical problem, but you don't really have any technical background as a founding team, that would be a problem. It's going to be very expensive for you to hire the people with the technical expertise. And so if it's a technical problem, you really want technical people addressing it. And if you're trying to have a software company in the healthcare space, if you don't have any experience on the founding team in healthcare, that could be a real difficulty. The second thing that teams need is just, I guess you would call it grit. Are you going to stick with it over the ups and downs? Because there's been a lot of discouraging things. If you're raising money, most people are going to tell you no. Are you able to stick with it in a way that's productive? And the third thing is, do you take feedback? Sometimes, when you start a company, you don't know what you don't know, and you don't know what's going to happen in the future. So founding teams need to be good at listening to what people are telling them around them, synthesizing that feedback and turning it into something that's useful for the business. Founders who already think they know all the answers will not be successful, because it's a surprising journey. You also want a team to be balanced. If there's somebody who's really good on the business side, that's great. If you need somebody on the product side, there are very successful single founder companies, but those people need to be really good at gathering up people who want to work with them that have the right skill sets. See, what should you study in college if you want? Okay. That's a really interesting question, because people come to venture capital from a lot of different directions. Some people take what I would say a traditional investment route. So you might undergraduate in economics or finance, and then get an MBA, intern for firms, and start working for a larger venture capital firm, or even do some investment banking and then switching to venture capital. That's a sort of a traditional. It's the same route you would take to working in a private equity firm. A lot of people come to venture capital later in their career, or from a different route. You might come from a technology company, being part of a startup team, to then investing in startups. So I know a lot of people who have been maybe not successful entrepreneurs, but who have worked in maybe somewhat mature venture-backed companies, who then later transition into working for a venture capital firm. So I think some of the most famous venture capitalists don't have any sort of background that you would really think would lead them there. There's a lot of people with, liberal arts degrees that just got really fascinated with business. A lot of people with technical degrees, engineering degrees, who are then able to be good and savvy investors with technical knowledge. So there's a lot of ways to do it. What you need is a good sense of numbers and finance. And you also need a desire to learn very quickly about things you know nothing about, because every company is different, and you may be vetting companies that you just don't know anything about their industry, and you have to learn enough quickly by talking to people and doing research in order to decide whether it's a good investment. Let's see, why do you think 2021 was such a great year for VCs, and why is 2022 not keeping up? As a venture capital investor, there were ways in which 2021 was great and ways in which it was terrifying. So if you have a company that was exiting in 2021 and or actually exiting in 2020, 2021, things were really great because valuations were high. And so, for instance, my firm had several companies that had an IPO in 2021, and they got really good valuations for their IPO. So that's great because you get your money back and you got it at you have a good investment return. What's terrifying about 2021 was that the velocity of deals you were looking at as a investor into a new company was really, you had to move very fast with not a lot of information. This is an environment I hate. And it also, those high valuations translate into a high purchase price for your new investments. And so if you bought into a company in 2021 for what you knew was kind of a high valuation, you might find that that company is now worth less in 2022 than it was in 2021. And the reason for that is just, simplistically, it's a market cycle, and venture capital does this. There's a lot of, it follows the stock market. If the stock market goes up and the public companies are expensive, more money gets pushed into private markets. And so the more money that's there, the pricing goes up there, and it's tied to comparative valuations in public markets. And when the public market resets, so does everything else. What did I like the most about my experience at UT Austin, and did I go to Mccombs? No, I do not have an MBA. I have I was a double major at UT, economics and history. And actually I thought I was going to be a lawyer. That was my plan. And through a series of strange events, I ended up working with a portfolio of entrepreneurial companies that were kind of mature. And after the disposal of that portfolio, I ended up working with smaller companies and making new investments. So I loved being at UT. I loved the variety of classes that I could take. I stayed in school 2 semesters longer than I absolutely had to because I kept on taking classes. It was the economics department is excellent at UT Austin, and I continue to support it because I think they do a really great job. Any college tips for students who want to pursue VC in the future? Well, going back to if there are organizations in the college you go to that are either focused on entrepreneurialism or focused on entrepreneurial investing, I would encourage you to be a part of those. UT, I know, has several. There's a venture fellows program this is a graduate school, Mccomb's graduate school program, which actually you get to intern at venture capital companies. And then there are several undergraduate programs that are around entrepreneurialism. So knowing what you can about all types of investing is helpful for venture capital. But venture capital itself is a type of investing that has its own quirks and own sort of patterns and, jargon and philosophy. So it's different. If you took several classes on, say, private equity investing, that would be helpful. But then when you went into venture capital, there would be some strange things. And so just like any type of investing, that it has its own quirks. But the more exposure you can have to entrepreneurs and people founding companies, that is really helpful. And it's easy to go on and to get invited to pitch competitions. There's a Techstars program in practically any city in the United States. You can go and listen to the Techstars participants pitch. That'll give you an idea of what a sort of good argument or a bad argument might be, because venture capital is also a game of just exposure and repetition. Could I share how I got on the path of VC investor? Well, like I said, I thought I was going to be a lawyer. And so I was going to apply to law school, but I was working actually as a controller for a tech services company. So although I didn't have a degree in accounting, I had worked in accounting for a number of years. And some friends of mine had invested in a company that had some similarities in terms of business model to the company that I worked for. And this company was not doing particularly well and was requiring more and more and more investment. And so I was asked to come take a look at this. And being sort of in the accounting mindset at the time, when I took a look at the financials of this company, I was not encouraged at all. And so my advice was, don't invest in this company anymore. And that was the right answer for that company. But through a series of events, I ended up consulting with investors on other companies. And some of these companies were great. And gradually, I ended up being given responsibility for trying to work out of a portfolio of companies that were entrepreneurial companies. Some of them were great companies that just hadn't taken a traditional venture capital path, which of course I knew nothing about at the time. And others of them were, companies that needed to be responsibly shut down. So I saw the not fun end to a venture capital portfolio before I got to have the fun of getting into an investment. And if there's one thing I'd say to folks is, remember, it's real easy to get into an investment and real hard to get out. And so that's that. I think that my approach has been definitely influenced by having seen the hard part before I got the fun, easy part. But that being said, where I learned to become an investor is from learning from other investors. It's still kind of an apprenticeship business in certain ways, not necessarily that you have to work for other investors, but being in an investor community was really helpful to me. I'm also a Kauffman Fellow. I went through the Kauffman Fellows program, which is essentially, it's a very unique program, but it's essentially professional education and networking for people who work in venture capital. And you learn by doing, and after you've been investing for a while, you gather up your own set of what venture capitalists call pattern recognition, which is very powerful. Once you've seen things a lot and you've seen a lot of pitches and a lot of entrepreneurs, pattern recognition. This very, very important tool for venture capitalists to have that exposure and to get those patterns. My caution to people is that patterns are also bias. So you have to constantly be thinking about whether this pattern recognition that you're having is appropriate for the situation, and whether you have to constantly re-examine your assumptions, or you might fall into, lazy patterns, which actually can become harmful biases. What type of people do you think are suitable for being a VC investor? Any special qualities that most VC investors have? Well, any investor needs to have a good grasp of numbers and how those work. But I think the most important thing you need as a VC investor, you need to be curious. You need to like variety and be very curious and willing to learn new things quickly. Because there's things change quickly. And you as a VC investor, a lot of times you need to be aware of newer trends and curious about them so that you'll dig in to the things that are going to be really influential in the future. So it's not a job of, some people get very, very deep in one area. And if you're a venture capital investor that only invests in, say, energy services tech, then you're going to need to be very, very deep in the energy industry. But in general, venture capital needs people who have a ability to be have a generalist mindset as well, even if you're not at a generalist firm, because you need to be able to synthesize trends across tech or across life science, and understand how they're going to affect your portfolio companies, and what other things you might need to learn in order to be a better investor. Why is it easy to get into being a VC investor, but hard to get out? Oh, well, it's not necessarily easy to get to be a VC investor, because to be a VC investor, you need to work for, a firm that people have given their money to. And maybe it's worthwhile talking really briefly, if we have time, about what that looks like, what a venture capital firm is structured like. But what I meant is, it's very easy to get into a company. It's very easy to write a check to a company. You can do some due diligence and get all excited and think it's going to be the biggest company in the world. And then you write the check to the company, and now you own shares in a company. But how do you get out of that company? In other words, how do you get a return on your investment? And the time and effort between writing that first check and 6, 8, 10 years later, being able to exit it for a really good multiple of your original investment, that's hard. So it's easy and fun to get in and hard to get out. And so I said my firm also invests in limited partnerships, other venture capital firms and GPs. And one of the things I look for when trying to vet a GP is, do they understand that? Because it's lots of fun to have somebody give you a bunch of money that you can go and give to super cool entrepreneurs. But at the end of the day, those investors want a return on their investment. And that part's hard. You have to have picked right, and you have to work and help your companies in between, and then you have to help them exit. And that can be quite difficult. Do VC prefer VC investors to specialize in business or specialize in an array of different fields? This is a perennial question. I think for some types of investing, you really do need to be a specialist. For instance, if you want to invest in blockchain, I suggest that you get really knowledgeable about blockchain and highly networked within blockchain, because that is that's going to be specialized still for a while. If you are investing in tech companies, you probably have some specialty within that. Tech is such a broad term. So you might B2B SaaS, for instance. I do a lot of that. I particularly like B2B SaaS companies. That means you're selling to other businesses, not to consumers, and you have a SaaS business model where you have recurring software revenue. So people do specialize, and oftentimes people have things they really don't like. People are consumer specialists. People are business model specialists. Within life science, this is an area where we invest through other funds, because in order to be a successful life science investor, you need to specialize in life science. This is my personal opinion. It is very complicated, and you need the right network of people to vet life science investments as well, because no one is going to know everything that they need to know about, say, oncology in order to make good investments. So, but there are a lot of firms that are generalist firms. And this is actually what I like about venture capital, is if you're a tech investor, even if you're a B2B SaaS investor, that is still a really, really wide array of companies. I mean, B2B SaaS is a business model. It's not a business. And so you're still going to want to, you might be investing in logistics, or you might be investing in fintech software. Those things might have the same business model, but have a very different industry and focus. And that's where being a generalist is really helpful, is you take lessons learned from one industry and apply it across industries within the same business model. But there's a million strategies. There's narrow strategies and wide strategies, and everybody's trying to do the same thing, which is pick some really good, exciting companies that are going to be very large in the end. So I think we're to the end of the Q&A. I hope this was helpful to folks. I'm happy to have Tiana and Harrison share my contact information. If anybody would like to reach out with any further questions, I'm happy to do my best.
All right, thank you so much, Joseph, for being here today. We really appreciate it.
All right, thanks so much. I'm gonna hang up. Bye.
All right, thank you. Have a great day. All right, hello, welcome back, everyone. It's 12 o'clock, so I guess we'll just start. We're saying the last for the best. We have Mr. Swart with us today. He is a money manager with more than $50 million of assets, 500 million. I'm so sorry about that. Of assets under management, and has been named one of the top 1,000 financial advisors in the country 5 times. And then he has also hosted a radio show called Money Talk for 27 years. So go listen to that if you like. And then thank you so much for being with us today, Mr. Sorry.
Welcome. Good to be here. Thank you, Tiana.
So yeah, I'll just hand it to you, and then you just start.
Okay, terrific. So Tiana has asked me to share about my experiences in the world of investing. And I start my remarks that way because I came to this profession as a second career, and I was 32, and I did not take, I was not a finance major at university, nor had I ever been an investor. And I didn't know the difference between a stock or a bond or a mutual fund. So the 44 years that I've been doing this, I've learned a great deal because I started with, in some ways, a clean intellectual slate. But I selected the career because I thought the characteristics of the career fit my personality. Principally, that I would be my own boss. And when you find careers where you can start as your own boss, generally the pay is generally close to zero. No one's going to pay you to be your own boss. Corporations will pay you to work for them. So it's been an interesting time. I'm really pleased that I chose this career. As Tiana said, at the end of last year, I had a bit over $500 million of clients' assets under management. And when I moved to Central Texas, I went into a business where you have to know people and connect with people. And I didn't know anybody. And before I talk about investments, I would say, I think the characteristics of a successful person in professional services are as follows. First, they need to be smart. Secondly, they need to have integrity. Third, they need to have good work habits. Fourth, they need to have a strong personality. And fifth, they need to have emotional intelligence. They need to have an intuitive understanding of how to connect with other human beings. And I want to start this way because you all are in the education system, and the education system, in my experience, focuses on information, which is terrific, but it's not enough. It's the ability to connect with other people that really is the secret sauce if you want to be a successful standalone CPA, attorney, architect, or investment advisor. And I think many times people have the other characteristics, but not that. My wife, who's a retired therapist, says that introverts love to have relationships and friends, but they get their energy from solitude. And extroverts like to take a walk by themselves and read a book, but they gain their energy from people. So as you move through your educational years and begin to think about a career path, frequently you'll be presented with a list of things you need to know and do. And those are certainly true. But if you choose a professional service career and you have the kind of personality that ultimately you want to have agency, you want to have authority, you want to have control over your own destiny, then those characteristics, in my experience, are essential. So I started, and I didn't know anything, and I worked for, I was an employee, but my compensation was zero. I had to go out and find clients. And I worked for a Houston, Texas-based firm. And during the 1970s and the early 1980s, we had a situation in the United States which wasn't supposed to happen according to traditional economic theory. And that is that we had high inflation and we also had a stagnant economy. Typically, high inflation comes about because of a robust economy where demand for goods and services exceeds supply, whether that supply is labor or manufactured goods. Nevertheless, that's cost push inflation. And in a recession, a declining economy, where now supply exceeds demand, then prices come down. But we had both of those. We had what was called at the time the Arab oil embargo in around 1974. And the common belief was that we in America, and for that matter, the rest of the industrialized world, had no control because the primary source of oil was in the Middle East and also in South America, of course, in Venezuela. And so we were hostage to the producers who could set the price by controlling how much they produced. And so most of the country was in this stagflationary environment, but there were a couple of major exceptions. Because of inflation, commodity prices were rising and were high. And so the price of agricultural products were high. And as a consequence of that, farmland and ranch land, if it was productive, rose in value. And energy-related businesses rose in value. So the stock market fell for a long time. And because interest rates were rising, the bond market fell for a long time. But if you lived in an oil-rich area like Texas or Oklahoma, or you lived where there was fertile farmland like Illinois, Iowa, you actually had very good times. So when I went to work, not knowing anything about investing, the firm was doing very, very well because it was a Houston-based firm. And so they recommended a stock portfolio that might include, now I'll use names that you might be familiar with, ExxonMobil, Chevron, Shell, British Petroleum, Halliburton, Schlumberger, and they recommended investing in Houston area real estate, commercial real estate, and multifamily housing, and investing in oil and gas exploration, and in owning oil and gas drilling rigs, for example. Now, you can make the case that if you owned all of those assets, were you diversified? And the answer is yes, because stocks are different than oil and gas drilling rigs, and real estate's different. But when oil, which was guaranteed to go higher, collapsed, then all of those investments collapsed as well. And Houston went from being a boomtown to a place where you could shoot a cannon through downtown Houston and not hit anybody. And all of those investments collapsed. Fortunately for me, because I was new in the industry, my clients lost a lot of money, but I didn't have very many clients. But that was a really, really important lesson, which is that diversification by the name of the asset class is not necessarily diversification. So my area of specialty is financial assets, primarily stocks, bonds, mutual funds, and exchange traded funds. But as I tell my radio listeners, I've managed to lose money in just about every asset class. I've lived through in Central Texas, and for that matter, it wasn't just Central Texas. It was a Southwestern phenomenon. I've lived through the boom and bust of the real estate business. We saw virtually all of our savings and loans and most of our large banks go under. And then the global financial crisis, which, as its name implies, was not a Southwest Texas or an American phenomenon. It was a global phenomenon where people really began to question the ongoing stability and efficacy of the global financial system. And between those things, I also experienced what now people call the dot-com bubble, where in IT technology stocks ruled the day. A small company started in Austin called Dell Computer. And there was a period of time over 10 years where the common stock of Dell Computer was the single best performing stock in the S&P 500, which is a broad-based index in the US equity market. It was the single best performing stock for the trailing 1, 3, 5, and 10 years. And it made a lot of people very wealthy. The stock went to $70. It then collapsed, and Michael Dell took the company private at $10.50. So if you bought it at 70, you never had a chance for it to come back because that's a permanent loss of capital. So what have I learned from these experiences? Every asset class, whether it's agricultural commodities, precious metals, commercial real estate, residential real estate, stocks, bonds, they all have cycles. But here's a key takeaway. The financial press is always full of very smart people being quoted about what they anticipate will happen going forward. So today, for example, you can be covered up with thoughtful articles about whether or not the US economy is going into a recession and whether or not inflation has peaked or not, and if it has peaked, to what level will it go? These people get paid to think about these things, but the relationship between their predictions and the return on your investments is not one-to-one. And so the key to investing is determining how long you anticipate your holding period. Because if you invest in the US stock market, as an example, and your time horizon is 1 day, your odds are about 50-50 that you'll have a gain versus a loss. However, the longer you invest in US stocks, the higher and higher the percentage is that you have a positive return, the lower and lower the percentage is that you'll lose money. So at 3, 5, 10 years, the number gets higher and higher and higher So when you look back over what we call rolling 10-year periods over a long time, 50 to 75 years, and you have a 10-year investment horizon, the odds are well in excess of 85% that you'll have a positive return. So when people say to me, I'd like to invest in the stock market, for example, the first question I ask is, for how long do you anticipate holding and maintaining this investment? And if they say, well, I've got this money now, but I'm going to buy a car next year, or I'm getting married and we'd like to buy a house in 2 years, that is a huge determinant in the menu of appropriate investments, because stocks are long-term investments and so is real estate. But there's very different characteristics in terms of their performance between real estate and stocks. And the primary reason, in my view, is what's called liquidity. So let's just do this kind of thought experiment. Let's suppose everyone who's on this call today, that we're all members of an investment committee for, let's say, the California Public Employees Retirement System. I use CalPERS because it's the largest institution of its kind in the United States. And let's suppose that we have $1 billion in stocks. We decide that that's more than we want, and we want to sell $250 million of our stocks. We can go to our trading desk, or we can call people on Wall Street, and we can raise that money like this immediately. Well, let's also suppose that we have $1 billion real estate portfolio, office buildings, warehouses, hotels, and we decide we'd like to reduce our real estate portfolio from $1 billion to $750 million. We can't call somebody. We don't have a trader who can sell it. It will take us, depending on the characteristics of the market, weeks or even months to effect the transaction. So as a consequence, when people own real estate as an investment, not talking about a house that you live in, when people own real estate as an investment, they are by definition longer-term investors because they don't have a choice. And in a rising market, like we've had over the last few years, there are adequate buyers if you choose to sell. But in the Southwest United States in the 80s, because you wanted to sell didn't mean you could, because there weren't buyers. Now, generally speaking, except in extreme, maybe once or twice in my career, there have always been buyers if you're a motivated seller. And that's in the stock market. So because the stock market offers virtually an instant liquidity, it's a much more volatile asset class over shorter periods of time. It will go up and down much, much more than a longer term hold in real estate. However, when you step back and ask the question, what are the two asset classes based on American economic history that have outperformed inflation over time? And the answer is income producing real estate and common stocks. So if an investor were to take the same long-term view of her stock portfolio as she would of her real estate portfolio, the odds are that both investments would be successful. But we're human beings, and we have an aversion to loss. In fact, there's a whole field in the academy called behavioral finance. And a couple of Americans, Dan Kahneman and Phil Thaler, Richard Thaler, have both won Nobel Prizes in studying human behavior around investing. And what they've proven in the lab is that as people, if you have an investment that appreciates 10%, you experience that as a 10% gain. But if you have an investment that declines 10%, you experience that as a 20% loss. And that's probably, now this is just my opinion, a function of evolutionary biology. And one reason we're still here is we're risk averse. So if Harrison and Tiana left the cave with clubs and went out hunting, and a saber-toothed tiger came along and ate Harrison, the next time Tiana saw a saber-toothed tiger, she'd run fast in the other direction. So what we have to do as investors, because we have this benefit, which is also a liability of instant liquidity, we have to overcome our nature. Warren Buffett, arguably the most famous US investor alive today, says, I want to be fearful when others are greedy, and I want to be greedy when others are fearful. And that's the opposite of the way in which we behave. So first, you have to match your investment strategy with your anticipated holding time. And second, you have to have an awareness of your own psychology as a Homo sapien. I will tell you that I don't have a stock quote machine. I have no idea how the stock market's doing today. I probably won't know until I watch the PBS NewsHour this evening how the Dow Industrials, the NASDAQ, and the S&P perform today, because frankly, I don't care, because I'm not interested in the day-to-day movements. So let's talk a little bit about portfolio construction. And here I'm going to focus primarily on financial assets. So when you're building a portfolio, the first thing you should ask yourself is, what is the purpose of this portfolio? Is it to save for college? Is it to save for a specific purchase? Or is it to save and invest for my financial independence? So what is financial independence? Financial independence is when there's a moment in your life when you get up in the morning, no matter what you choose to do that day, you do it because you want to and not because you have to. So if you love what you do professionally and it's emotionally satisfying and intellectually stimulating, terrific. But if you reach a point in your life where you do it for those reasons and not because you need the money, that's financial independence. So I would submit to you, based on my 44 years experience, very few people attain financial independence. And they tend to look at their careers as a means to an end. So if you're investing for a liability, an expenditure that's 5 years from now, then that makes you, in my opinion, eligible to talk about portfolio strategy. And in the financial asset world, your choices are fairly limited. You can own individual stocks, you can own individual bonds, or you can own mutual funds or a very similar type of investment called exchange traded funds. And here's my experience. If you choose to own individual stocks, you'll have the opportunity to do better, make more money than owning a broad-based index or group of stocks, but you'll also have the opportunity to lose a lot of money. If you're the person who bought Dell at 70 and it went away at $10.50, that's much worse than if you had owned a Standard & Poor's 500 index mutual fund or exchange traded fund, and Dell was one of 500 companies. Would it have had a negative impact on your return? Naturally, and yes, it would, but it would have been much smaller than if you had owned individual stocks. So if you own individual stocks, you take on greater risk to obtain greater return. The second challenge in owning individual stocks is that you may pick great companies, but the stocks may not be great investments. And they may not be great investments for at least a couple of reasons. One, they're just out of favor. So last year, if you owned energy stocks, you had a terrific year. But in 2019, you had a terrible year. Last year, if you owned the so-called FANG stocks, Facebook, Alphabet, which is Amazon, Alphabet's Google, Netflix, other companies like NVIDIA. You did Tesla, you did terrific. This year, you're doing terribly. So investors' enthusiasm changes over time, and you don't know when it's going to change or what fashion. So let me give you an example, because I know some of you are not on this call, don't live in the greater Austin, Central Texas area. So while we're considered to be a high-tech or IT center, we have some amazing businesses here that are not IT based. For example, Yeti is founded here, Tito's Vodka, Kendra Scott Jewelry, Bumble, which is a female-oriented dating app, and Whole Foods Market. So John Mackey started Whole Foods Market in, I believe, 1982. And we had a flood and his store was wiped out and he didn't have insurance to cover and he had to borrow money to get more groceries into Whole Foods Market. And he went on to create a global company and sold it to Amazon. But I remember a period of time when people would call me on my radio broadcast and they would say, what in the world is wrong with the stock of Whole Foods Market? It just lays there. And yet when I go to the stores, they're packed. And this was a time when Dell was skyrocketing. Well, then we had the market peak in March of 2000 and IT stocks collapsed and Whole Foods Market took off. Same company, but investor sentiment changed. The other thing that you have to watch out for is valuation. So, for example, we live here in Austin in an extremely heated real estate market. Let's just pick residential real estate. Our prices year over year were up approximately 40%, according to the Wall Street Journal, the #1 metropolitan area in the country for price appreciation. Now, if you are buying a house because you think it will appreciate and you're buying it today versus a year ago, what are the odds that you're going to enjoy another 40% return? Probably zero. So valuation matters. The outlook for companies matter. The outlook for the economy matters. The valuation really, really matters. So I decided, after losing money in individual stocks, that I wanted to use mutual funds because I wasn't making such a narrow bet, and I offset the risk that that entails. So in my portfolio, I use mutual funds and something called exchange traded funds, which are very tax efficient and very inexpensive to own. But if you are investing for 5 years or longer, you then have to really, really understand the distinction between diversification and correlation. What do I mean by that? Let me give you a real world example. If on January the 1st of 2008, you had a portfolio of US stocks, foreign stocks, high yield bonds, real estate investment trusts, which are publicly traded daily portfolios of real estate, commodities, would you have been diversified? Absolutely, you were diversified. And you lost a lot of money because US stocks were down 40% for the year, international stocks 50%, Chinese stocks 60%, high yield bonds 20 to 25% decline, real estate investment trusts peak to trough of minus 55%, and oil went from $135 in July of 2007 to $35 in November. And you were diversified and you had horrific results. On the other hand, why was that? Because you confused diversification with correlation. And all of those asset classes I described were positively correlated with one another. So they tended to rise and fall, Not exactly, but I'll give you a mathematical example. If two asset classes have a perfect correlation and they go up and down exactly the same, which never occurs in the real world, they would have a correlation of 1.0. So high yield bonds, okay, we have low interest rates, high yield bonds, which are called junk bonds, pay a higher income. Why wouldn't I put that in my bond portion of my portfolio? Because high yield bonds are 0.8 correlated to stocks, meaning that the vast majority of the time the stocks fall, guess what? So do high yield bonds. So when you're building this portfolio and you're thinking about diversification and you have stocks and high yield bonds, you're diversified, but you're also fully correlated. Now back to 2008. So I'm going to use the two largest stock and bond funds as an example. If you had $1 million in the Vanguard Index 500 and you lost 40% in the year, now you have at the end of the year $600,000. And if you put 60% in the Vanguard Index 500 and 40% in what was at that time, no longer, the largest bond fund, PIMCO Total Return, you lost 25%. Now, losing 25% is not a pleasant experience. But let's walk through what happens next. In bucket number one, we have $600,000, which means that we have to make $400,000 to get back to our starting point, and that's a 66% return. In bucket number two, we have $750,000, which means that we have to make $250,000 to get back to our starting point of $1 million. That's a 33% return. So even though the difference in the rate of decline was only 15 percentage points, minus 40% versus minus 25%, the amount, the hurdle, the rate of return to get back to even is 100% greater, 66% versus 33%. So one of the keys to making attractive inflation-beating returns over time is not having large drawdowns, which means losing a lot of money. Another favorite saying of mine from Warren Buffett is, you never know who's swimming without a swimsuit until the tide goes out. What he means by that is, in good times, you can take a lot of risk. You can buy Bitcoin and have 100% return. But when Bitcoin drops 50%, your Bitcoin drops the same amount as everybody else's. So understanding correlation is really, really important. And those data are available. So building a portfolio, you have to decide how much do I want to put at risk, and that can help you with your return targets. And I'll give you an example. And this doesn't mean that this is what's going to happen, but it's a way to think about the risk. So if you have 60% of your money in global stocks, and you have 40% of your money in non-correlating assets, and let's suppose that the stock market drops 60% and your non-correlating assets just stay flat. They don't go up, they don't go down. Well, then 60% of your portfolio declined 20%. So your overall portfolio declined 12%. That's a way to think about the ways in which you're taking risk. Now, if your objective is financial independence, if you leave the money in the bank, you buy certificates of deposit, you buy Treasury Securities, money market funds, you won't attain your objective because that's called cash. And the historical data is very, very persuasive that on an after inflation basis, cash returns a negative return. So today, interest rates have risen. 10-year Treasury note is priced to yield 3%, more or less. It got as low as 1.5%. But in the latest inflation print, see it, the consumer price index is over 8. So if you have a 3% yield with an 8% inflation rate, you have a negative 5% return. That's called the real rate of return. So if your objective is to grow the money faster than inflation with an acceptable level of risk over a longer time horizon, which is a fancy way of saying obtaining financial independence, then you have to have money at risk. You can't obtain your objective, whether it's in your employer-sponsored retirement plan, 529 college savings plan, or your own investment portfolio with taking risk. At the end of the day, you have to understand that there will be times when there will be surprisingly large declines in the value. And that's why the earlier stages that I said are really important. Now, I'm going to stop here, Tiana and Harrison. I show it's 12:33 here in Central Texas. It's my understanding that we have till 12:50. And so I'm happy to answer any questions or talk about topics that I haven't talked about. If people want to talk about investing in real estate, if they want to talk about cryptocurrencies, whatever, the gold, commodities, I'm open to any of those things.
All right, I think the Q&A should be rolling, so I'll do it sometime. I do see one. So like, what's one piece of advice you would give to students who want to be an investor in the future?
Tiana, I'm sorry, your mic is not very good. I couldn't understand your question, please.
Okay, so I think there's, the first question is, what is one piece of advice you would give to students who want to be an investor in the future?
Yeah. This sounds a little weird, but know yourself. I've known people who really, really enjoy the stock market. They actually, on a very personal note, Harrison's great-grandparents were good friends of mine, and his great-grandmother loved individual stocks, and she loved to read annual reports and pay attention to the stock market. And a mutual fund was never very interesting to her because she didn't know what the heck she owned. She wanted to take a rifle. She wanted to own Exxon and not Shell. She wanted to own Halliburton and not Schlumberger. If that's who you are, that's fine. Understanding what I've already said and trying to build a portfolio that you're not concentrated in one or two industries. And you also have to realize that a lot of the great companies are so small you've never heard of them. And a lot of the great companies are outside the United States. So my first piece of advice is, if you're going to be a financial asset investor, determine whether or not it's important to you to own individual stocks. If it is not, then the best thing you can do to start, because you have a long horizon, you're a young person, is you pick a broadly based group of stocks. So that would be an index, probably one that follows the total US stock market or the Standard & Poor's 500. And because at least 50% of the world's companies are outside the United States, you want to own a broad index of international. So you might start owning something called exchange traded funds because they're very, very cheap. And you might have 75% in a US total stock market index fund and 25% in an international index fund. The nice thing about this is you're not going to have all the money you're ever going to have to invest. So you can set up an account at Schwab or Fidelity or Vanguard or somebody like that, and you can put money in periodically. That's a terrific idea if you can afford to do that, because the stock market's going to go up and the stock market's going to go down. And if you're putting in the same amount of money every month, every 6 weeks, sometimes you're going to be buying fewer shares because prices are elevated. And sometimes you're going to buy more shares because prices are depressed. So you effectively end up having the market be your friend, because when other people are scared and are selling, you're buying. So I'd first decide if I knew myself. If I love stocks, that's okay, but I need to have an international fund because I want to ever know those. I probably need a small cap fund because I want to ever know those, because I'm going to be buying names that I understand, or maybe I interact with, use their goods or services. So that would be my advice. Now, the second part of it is, if you have the time and the interest, is reading the financial press. The easiest thing to do is you read the Wall Street Journal. I was thinking yesterday, I didn't have a chance to read Tuesday's Wall Street Journal. Yesterday afternoon, I read yesterday's. And I learned a bunch of stuff that I didn't know. And did it immediately translate into an investment idea? Of course it did. But if you take a subscription online to the Wall Street Journal, because it's good journalism, and some of you may know a lot about journalism, the old phrase in journalism is don't bury the lead. Always in the first paragraph, tell the reader what you're going to tell the reader. So if you read I go through the Wall Street Journal and I read the headlines, and then I read the first paragraph if the story is interesting. Or if it's about the war in Ukraine and I've already read about that, learned about that elsewhere, I skip it. If you did that for 6 months, which nobody does, if you did that for 6 months, you would be amazed what a thoughtful and informed person first, and a thoughtful and informed investor second. That's the best piece of advice from an educational standpoint. And then for someone who really has too much time on their hands, then the second thing to read is it comes out once a week. It's called Barron's. It's published by the same people that publish the Wall Street Journal, and it's solely oriented to investors. There's no current events in there, no sports, no movie reviews. So the Wall Street Journal would be my first piece of advice, and Barron's magazine would be my second. Barrons.
Thank you. So the next question I see is, when should I start investing in Roth IRAs?
So Roth IRAs are a terrific idea. You have to have earned income. Somebody can't give you the money and put it in a Roth. You have to have earned income. But for many, many years, all kinds of retirement plans had a benefit, which was when you put the money in, usually you didn't pay taxes on that money. It was tax deductible. So if you were in a 20% income tax bracket and you put $1,000 in an IRA, if you didn't do that, you would only have $800 because $200 went to taxes. Pardon me. The second benefit was, as long as you left the money in there and let it grow, you didn't pay any taxes on the growth. And you had an incentive to leave it in because you were penalized if you took it out before age 59 and a half. You had to pay income tax plus a 10% penalty. Well, along came the Roth IRA. And Roth IRAs had the same maximum contribution. And it's really modest, like $5,000 or $6,000. It's not like $100,000 or something. But when you put money in a Roth IRA, you don't get a tax break. It's after-tax money. But like an IRA, you pay no income taxes or no capital gains taxes on any of the growth as long as you leave it in there. Once it's been in 5 years from the initial investment, and you're over 59 and a half years of age, you can take the money out completely free of any taxes. That is a big deal. The second feature, when comparing a Roth to an IRA, or for that matter, a 401k or an SEP IRA, is that you have a required minimum distribution. If you have money in an IRA, when you turn 72, whether you want the money or not, you have to begin taking it out. That's called the required minimum distribution, or RMD. There is no RMD in a Roth IRA. You get to choose when to take it out once you're over 59 and a half, but you don't have to begin to take it out when you're 72. So Roth IRAs are a great way to build for your future and your financial independence. And earlier advice I gave about buying a broadly based index fund, absolutely you can do that and should inside the Roth IRA.
All right, okay, thank you. The next question I see is, what do you think about investing in land? Like land in general, not real estate.
Land, but land in general. Yeah. So when you think about the various types of real estate, there's income producing real estate. Now, that sometimes is a bad name because right now, if you want to buy a rent house in Austin, Texas, and you put down 20% and you get a mortgage for 80%, the rental income won't cover your expenses. So you can call it income producing real estate, but it's not producing any net income. But it does have cash flow because you have renters. So land, on the other hand, is the most speculative of real estate because you're betting that something is going to occur to make that land grow in value. You're going to discover minerals, oil and gas. You're going to build an airport nearby. The city is going to grow out to that area, and it will cause the land to grow in value because the land's not producing any income. So just buying a piece of land, in some deserted area is not proven to be a good investment. You have to have a case, a rationale for why that land is going to appreciate.
Right, thank you. The next question is opinion on cryptocurrencies.
Cryptocurrency?
Yes.
Sure. So I think there's a distinction between cryptocurrency and blockchain technology. So everything I read and the experts with whom I speak say that the technology, which is distributed computing, is very innovative. And I know that big asset management companies like Vanguard, JP Morgan Chase have hired really smart people to work on and understand how blockchain technology will be beneficial to their businesses. Cryptocurrency, on the other hand, is a very different thing. And some people who are, let's say, of the libertarian persuasion, like it because it's not what we call a fiat currency. It's not issued by the European Central Bank, the European Union, England, Japan, the United States, China. But that because of its anonymity, it's a wonderful place for criminals to have transactions. And it's a great place for hackers to operate. And you can call it a currency, because that's what we all call it, but it doesn't have the characteristics of a currency. Let me give you an example. Let's suppose that you and I enter a contract, and I'm going to deliver some goods or services over the next 6 months, and you're going to pay me monthly over 6 months in cryptocurrency. Why would either one of us ever do that when we don't know what the value of the cryptocurrency is? If we agree to pay each other in euros or yen or dollars or sterling, we have a pretty good idea of what that's worth, right? But if we do it in Bitcoin, we don't know if it's going to be 20% more or 20% less through the life of the contract. So it doesn't bear that characteristic of a currency. The second thing is, and you see this happening, is that I can't speak for what's going on in Europe, but here in the United States, the Securities and Exchange Commission, the chairman's a man named Gary Gensler, he has publicly said that they're looking at doing more regulating. There is no regulating. So I would characterize cryptocurrency today as a total speculation. And it's a little bit like going to Las Vegas and saying, I got $1,000 and I'm going to play blackjack. When I'm out $1,000, I get up and I leave. If I make 2,000, that's wonderful. I wouldn't buy cryptocurrency except with money that I could afford to lose. I think we got time for one more, Tiana.
All right. Do you want to choose one? Do you see all the questions, or should I just?
Okay. Down here in the Q&A, sorry.
Yeah.
What do you think will happen to Austin's residential real estate market this year and the next? How much impact does higher interest rates have on it? It's a great question. It's already starting to have an impact we're starting to see a reduction in the increase in pricing because mortgage rates, if you had a mortgage at 2.75%, you could afford a lot more house than at 5.5%. So the number of qualified buyers is diminished because of higher mortgage rates. Now, the positive, and we all know this, the tailwind, is people are still moving here. But we now have about 2 months supply, which is still way below a healthy 6 to 9 months. But we got down to 2 weeks. So I don't know whether the tide has turned, but it certainly appears that we're not going to have the same kind of appreciation over the next 2 years that we've had over the last 2. Also, we're way behind in building apartments in Austin, thousands of units behind. But thousands of units are under construction. If you drive around town, you can see that. So that's also critical because if you get a sufficient amount of apartments, then that puts less demand on the residential market. So I would say to you, I think because the predictions for Austin growth are still quite good, that the price action is probably upward, but not to the same extent that it has been for the reason that you say in your question. First, higher mortgage rates, and secondly, a little bit more supply. So that's how it looks to me. And I think that's it, Harrison and Tiana.
All right, thank you so much for coming and joining us today.
You're welcome, and good luck to everybody. Thank you.
Thank you.
Bye-bye.
Have a great day.
Bye-bye.
Bye. Well, everyone, that's the end of today. Hopefully we'll see you tomorrow at 9 a.m. Central Time again. Thank you for being here today.
Yeah, thank you all
Bye.
so much. Bye, y'all.